Please like, share, and subscribe. Wishing you happiness and good luck every day.
All right, let's just jump right in. For as long as we can remember, we've been told that financial markets are basically a big math problem, right? A world of algorithms, probabilities, and just cold, hard data. We're taught to just push our emotions aside and trust the numbers. But what if that entire idea is just wrong?
What if the real key to winning isn't a better spreadsheet, but a deeper understanding of the human mind, starting, most importantly, with your own? Well, that's the pretty radical idea from performance coach Denise Shull that we're going to unpack today.
The author Nassim Taleb famously said that it looks like we have the wrong user's manual for our own minds. And that's exactly what's happening here. The conventional wisdom that tells us to separate emotion from reason isn't just a little off, it's actively holding us back. It's like we've been trying to operate this incredibly complex machine with instructions for a pocket calculator.
This quote just flips the whole script, doesn't it? Denise Shull argues that we've put our intellect up on a pedestal, made it the rational CEO of our decision-making. But here's the reality. Our feelings, both the ones we notice and the ones we don't, they're the true majority shareholders. They're driving every single perception, judgment, and decision we make.
So, to really get a handle on this, we first have to deconstruct the central myth that the markets are built on, this powerful illusion of numbers. So here it is, the core conflict. The old way of thinking, the myth, tells us to ignore our gut feelings and just put all our faith in the numbers. But this new paradigm, the reality, suggests the exact opposite. Your emotions aren't just noise, they're signals, they're data. The real game isn't about reading charts, it's about reading people. We fall for this seduction of statistics because, let's be honest, numbers feel safe, they feel objective, certain. We're taught to hunt for patterns, for that perfect confluence of circumstances where, in the past, X happened, so we bet on X happening again. The problem is, this almost religious belief that math can predict the future has, as Shull so perfectly puts it, led to billion-dollar bonfires. And why? Because it completely ignores the single most important and unpredictable variable in the whole equation.
Think about it this way. Poker is a closed system. You've got 52 cards, and that's it. You can actually calculate the odds. But the market? That's not a deck of cards. The number of variables, all the human actions and reactions and emotions, is infinitely more complex. Trying to apply a simple probability to it is like trying to navigate the Pacific Ocean with a map of a small pond.
So if it's not a numbers game, then what in the world is it? Well, it's a people game. The whole goal shifts. You're not trying to predict prices, you're trying to predict the people driving those prices.
And this is absolutely crucial to understand. A price is not a fact. It's an opinion. It's simply the collective perception of value held by millions of human beings at one specific moment in time. A stock price is just a reflection of what people think something is worth.
The brilliant economist John Maynard Keynes understood this way back in the 1930s. He said, investing isn't a math contest at all. He said, it's a beauty contest. And really wrapping your head around this one analogy is the key to unlocking this whole psychological game.
Okay, let's break this down, because it's so good. In Keynes's analogy, imagine a newspaper runs a contest. You have to pick the 6 prettiest faces from 100 photos. The winner isn't the person who picks the faces they like. The winner is the person whose picks most closely match the average picks of everyone else. So what you think doesn't matter. But here's the kicker. It's not even enough to pick who you think the average person will find pretty. To win, you have to go to a third level. You have to anticipate what the average opinion expects the average opinion to be. That is the game of the market.
And there it is. That's the huge strategic shift. You don't get paid for being right about the facts of a company. You get paid for correctly predicting when and how other people's perception of those facts is going to change. It's all about being one step ahead of the crowd's psychology.
So, if the market is just this giant game of human perception, how do you actually win? The answer is pretty radical. You start treating your own emotions as a critical source of data. This is such an important distinction. We're so quick to blame our emotions for bad trades, but that's a mistake. Fear itself never lost you any money. It was the action you took while you were feeling that fear, like panic selling, that's what actually cost you. So the goal isn't to get rid of emotion, it's to understand what it's telling you before you act on it.
To do this, you have to manage what Shull calls your psychological capital. The easiest way to think about it is like a personal energy account. It's the total amount of physical, mental, and emotional energy you have available for making good decisions.
When you're tired or stressed or just emotionally drained, your psychological capital is low, and that's when you're way more likely to make a costly mistake. Now, the lens through which we spend that capital is what Shull calls the FC, or feelings context. This is basically the sum of all the physical and emotional feelings you're experiencing at any moment. Think of it as the background state, or the filter, that colors every single piece of information you take in.
And we can break this down into two layers. The foundation is the general feelings context, the FC. This is your basic physical state. Are you tired, hungry, feeling good, energized? I mean, trying to trade when you're exhausted is just a recipe for disaster because your whole foundation is shaky. Then, layered right on top of that, you have the EC, the emotional context. These are the more specific emotions, like anxiety about missing out on a trade, or that deep fear of losing money, that link all your past experiences to the judgment you're about to make. Both of these contexts are shaping your decisions all the time.
But here's where it gets really deep. This isn't just about how you feel right now, in this moment. Some of our most powerful emotional contexts are buried deep in our unconscious. They are repeating patterns, or fractals, that were created by our personal histories, and we just play them out over and over again without even realizing it.
This picture of Romanesco broccoli is the perfect visual for this. A fractal is a pattern that just repeats itself at every scale, big or small. Shull argues our psychology works the exact same way. An early experience with risk or loss can create this core emotional pattern inside of you. And that pattern then repeats itself in your relationships, in your career, and yes, absolutely in how you react to a stock chart going the wrong way. Your reaction to the market might have way less to do with the data on your screen and way more to do with some argument you had with your parents 20 years ago.
So, if all of this is true, what's the solution? I mean, how do you actually use this stuff to your advantage? This brings us to what you might call the ultimate, insurmountable edge.
Shull suggests this really powerful mental shift. Stop thinking of yourself as a financial analyst and start thinking like a professional athlete. A top-tier quarterback doesn't just study statistics. They obsessively manage their physical energy, their mental focus, their emotional state. They know that peak performance always begins with managing their own internal machine first.
So here's a practical game plan. Step 1, manage your physical energy. Seriously, don't trade tired. Sleep deprivation literally makes you misperceive risk. Step 2, shift your focus to reading people, not just charts. Step 3, get a huge risk edge just by constantly asking yourself, what is my emotional context right now? And step 4, this is where it all comes together. You use that self-knowledge to get better at predicting the emotional context of the entire market.
Because at the end of the day, in a world where everyone has access to the same data, the same charts, the same algorithms, the only true, lasting edge has to be internal. It's the one thing nobody can ever copy or take away from you. Deep, honest self-awareness is the ultimate competitive advantage. In the end, Shull's argument is that the markets are really just a giant mirror, reflecting our collective human psychology, all our hopes, our fears, our unconscious patterns. So the final question isn't really about the market, it's about you. When you look into that mirror, what part of your own psychology do you see looking back?
Our story starts with a man at a total breaking point. See, he's caught between two completely different worlds. The absolute adrenaline rush of a Wall Street trading floor and the quiet, thoughtful halls of a university. And his journey from one to the other, and maybe back again, it all kicks off in a single moment of just bone-chilling frustration.
So, let's meet Michael. He's just gotten off the last flight from Denver, he's wiped out from a ski trip, and this is what greets him, a taxi line that seems to stretch on forever. And that groan, you've got to be kidding. It's about way more than just the long wait. It's kind of the sound of a life that's stuck in neutral.
Okay, so picture this. It is almost 1 in the morning at Chicago's O'Hare Airport. There's a nasty 15-degree wind just whipping through this line, and there are about 80 people ahead of him. This isn't just about being cold, you know? It's the perfect metaphor for where he is in his life. He is literally frozen, and he has no idea which way to turn.
So who is this guy, Michael, standing in the freezing cold? His story is this incredible journey from the trading floors right to the university halls. And to really get why he's so frustrated, we got to rewind a little bit and see exactly how he ended up here.
Talk about whiplash, right? In the late 90s, Michael is a proprietary trader, and he is a master at what they call the momentum game. Basically, this high-stakes chess match of buying stocks that are hot and shorting the ones that are not. Then 2002 happens. The dot-com bubble bursts, his firm shuts down its Chicago office, and just like that, the game is over. So what's he do? He goes back to school, first for an MBA, but then he decides he wants something more theoretical. So he pivots to a PhD in decision theory.
But here's the thing. There's this tension simmering just under the surface. Michael's dad, a CFO, completely disapproved of his son's career choice. He saw traders as these necessary evils, totally lacking in morals. And that created this huge rift between them right from the get-go.
So after all the chaos of the market crashing, Michael was just craving some kind of order. He was looking for a refuge, really. And he found it in a world that was the absolute polar opposite of the trading floor, this structured, predictable world of academic theory. And you know what? For a while, it was a perfect fit. Michael had always been a book lover, and he found it absolutely exhilarating to just think, to spend his days with these abstract models of decision-making. It was a clean, logical world, a huge contrast to the messy emotions and the gut feelings that pretty much ruled the trading floor. In academia, logic was king.
But that world he left behind?
Yeah, it wasn't quite done with him. After the 2008 financial crisis, headhunters started calling him up. And the pull of the trading desk, the very world he had tried so hard to escape, well, it turned out to be a lot stronger than he thought. And this was his core conflict, right here. On one side, you've got the ivory tower, slow, careful thinking, abstract models. And on the other side, the trading desk, pure, fast-paced action and that thrill of running money. Michael was caught smack in the middle of these two colliding worlds. Despite how much he enjoyed the intellectual side of things, deep down, he couldn't deny the truth. He'd turned down a few offers, but then one came along that was just too good to pass up. A seat on the trading desk, a chance to manage a portfolio. He just had to admit it to himself. He missed the game. He really, really wanted back in.
In this decision, it wasn't just a career move. It was deeply personal. Going back to finance didn't just disappoint his father. It lit up what's described as a simmering rage. It just reopened all those old wounds and threw them right back into their old conflict.
Which brings us right back to where we started, that freezing cold taxi line. Michael's lost in thought, but he's about to have this chance encounter that is going to connect his two very separate worlds in a way he never saw coming. He spots a face he thinks he recognizes from campus. He hesitates for a second, then he just goes for it. And that one simple question, it leads to them sharing a cab, which leads to a conversation that's going to change his entire perspective, and to meeting a woman named Renee. So, in the warmth of the cab, Michael starts learning about a field of study he's never even heard of before. It's one that connects the mind, the brain, and the body to understand the very thing he's been studying, how we all make decisions. Renee tells him she's a grad student at the Biopsychology Institute. Now, even though Michael himself is a decision researcher, he's never heard of it, which leads him to ask the obvious question, what on earth is biopsychology? And Renee's answer is a total revelation for him. She explains that most traditional theories treat the mind, brain, and body like they're totally separate things. Biopsychology, she says, brings them all back together. It's the study of how our biology, our brains, our hormones, our gut feelings, actually shapes our thoughts and our decisions. For Michael, it's like a light bulb just goes off. This connects with him instantly. His own department often gets mistaken for behavioral economics, a label he thinks is way too narrow. Because, as he puts it, that field only looks at the behavior itself, the end result. He says, what causes the behavior? That's the real question. Their conversation gets cut short when the cab gets to campus. Michael pays most of the fare, and as he puts the cash from Renee into his pocket, he feels something else. Her business card, tucked right inside the money. A pretty promising connection, made completely by chance in the freezing cold. So the very next afternoon on campus, all those ideas from the cab ride are about to get really, really real. Michael's dissertation advisor has an offer for him, and it's one that's going to make his two worlds collide in a way he absolutely could not have predicted. His advisor, a Professor Zanis, pulls him aside. Turns out he's co-sponsoring a new guest lecture series with the psychology department. Okay, interesting. Then he drops an interesting little detail. The speaker has a background on Wall Street. Zanis thinks it's right up Michael's alley. Okay, now Michael is really listening. And then, Bam, the bombshell. The speaker is from the Biopsychology Institute, the exact same department he had just heard about less than 24 hours ago. The coincidence is just, well, as Michael later put it, mildly amazing.
And the title of this lecture, The New Psychology of Risk, Uncertainty, and Decision-Making. It is a perfect summary of everything Michael has been wrestling with, the numbers-driven world of trading and the academic world of decision-making. I mean, it's like the title was written just for him. You know, Michael's journey from relying on gut feelings on the trading floor to relying on pure logic at the university, it really forces us to ask a big question about ourselves. When the stakes are high, how do you make decisions? Is it all just pure cold logic? Or is there something deeper going on? A connection between your mind, your brain, and your body that maybe you're not even aware of?
All right, let's talk about our relationship with numbers. It's complicated. We put so much trust in them, we build our whole world on them, but sometimes, and this is the crazy part, they can look you right in the eye and lie. Okay, let's start with the basics, right? Something we can all agree on. 2 + 2 = 4. It's solid. It's a universal truth. Doesn't matter where you are, who you are, this is a fact. It feels safe, you know? It's certain.
But here's where things get interesting. That beautiful, simple certainty, it starts to get a little fuzzy the second we change the context. Just add one little symbol, like a percent sign. Suddenly, the number 20 isn't just 20 anymore. It's a 20% chance of rain or a 20% chance of losing all your money. The number's the same, but that symbol throws us into a world of risk, and you guessed it, uncertainty.
So here's our game plan for today. First, we're going to tackle this illusion of certainty that numbers give us. Then, we'll dive into what happens when statistics really deceive us. We're talking big-time consequences. After that, we'll get into the psychology of it all, take a wild look inside our own brains, and then wrap up by talking about what numbers just can't tell us.
All right, first up, the illusion of certainty. The bottom line is, a number by itself is pretty much meaningless. It's the context around it, the plus sign, the minus sign, the percentage sign, that gives it its power. And as we're about to see, that idea goes way, way deeper than you might think.
You know, whenever we try to put a number on something that's totally up in the air, we call it enumerating chance. We take this messy, unpredictable future and slap a nice, clean number on it, like a 20% probability. And this does something really powerful to our brains. It kind of tricks us. We feel this sense of relief, like we've somehow tamed the chaos and made the uncertain certain, like we've turned it back into 2 + 2 = 4.
So this isn't just some philosophical idea. Let's talk about when this goes wrong, like catastrophically wrong. Our obsession with putting numbers on everything has led to some massive failures, lighting what you could call billion-dollar bonfires in our global financial system.
I mean, just think about it. In a little over a decade, the world got hit with 3 huge financial crises. And each time, the most advanced, most sophisticated statistical models, the ones built by the smartest people on the planet, basically said these events were impossible, so improbable they shouldn't even happen. And yet, they kept on happening.
And this quote just says it all. Back in 2007, the CEO of Goldman Sachs called the crazy market swings a 25 sigma event. Now, to put that in perspective, that's a statistical event so ridiculously rare it's not supposed to happen even once in the entire lifetime of the known universe. He was basically saying he'd just seen a ghost, a statistical ghost.
And get this, that impossible event? It wasn't some fluke. Just 13 months later, another impossible thing happened, when every single market on the planet, all at once, moved in the exact same direction. It just goes to show you there's this massive, gaping chasm between what the numbers predict and what messy, unpredictable human reality can actually deliver.
So you gotta ask, right? If these models are so obviously broken, why on earth do we keep trusting them? Why do we cling so tightly to this false certainty? Well, it turns out the answer is hardwired right into our own psychology.
It really comes down to this quirky thing in our brains called ambiguity aversion. Study after study has shown that we humans have a huge preference for known risks over unknown risks. So if I gave you a choice between picking a ball from a jar with exactly 50 red and 50 black balls, or picking from a jar where the mix is a total mystery, most people choose the first jar. Every time. We'd rather deal with a risk we can quantify even if the odds of losing are exactly the same. We absolutely hate ambiguity.
Poker is the perfect place to see this in action. The novice player, they're totally obsessed with the numbers, the odds of drawing that inside straight. They think it's a numbers game. But the expert, they know the numbers are just the entry fee. The real game is a people game. It's about reading your opponents, spotting a bluff, managing emotions. They don't play the cards, they play the person sitting across from them.
So it's pretty clear our brains aren't just calculators. And this whole thing, our gut feelings, our ability to think beyond the numbers, it's not a bug, it's a feature. And the reason why might actually be deep inside the physical structure of our brains.
For like decades, we've had this idea that the brain is just a neural network, kind of like a computer, with neurons firing off electrical signals. We even build computer AI based on this idea. But it turns out that's not even close to the full story. In fact, it's massively incomplete.
Just take a look at what our brains are actually made of. Those famous neurons, the cells we thought did all the thinking, all the heavy lifting, they only make up about 15% of our brain. So what in the world is the other 85% doing?
Well, for the longest time, scientists thought this other 85%, these glia cells, were basically just junk, brain glue, there to support the important neurons. But now we know they are a huge deal. They communicate in a completely different non-electrical way, almost like a radio broadcast. And they can actually listen in on and even control the signals in the neurons. They might just be the key to our most complex, abstract thoughts.
And if you need proof of how important these cells might be, check this out. A study of Albert Einstein's brain found that while his neuron count was pretty average, his brain had a much higher ratio of these glia cells to neurons. In some parts of his brain associated with complex thought, it was almost double the average. It suggests our highest intelligence isn't just about raw processing power, it's something way more nuanced.
Okay, so if our own brains are so much more than just calculators, what can we learn from an actual calculator? A really smart one that tried to act human.
You probably remember this, right? When IBM's supercomputer Watson just destroyed the best human players at Jeopardy. It looked like the ultimate win for pure numbers and processing power, a triumph for the machines. But not so fast. If you look under the hood, you find a very different and much more human story. So here's the secret sauce to how Watson worked. It would analyze the question, search through millions of documents, and come up with hundreds of possible answers. But here's the kicker, the most important step. Before it ever decided to buzz in, it calculated a confidence level for every single answer. It wasn't enough to just find an answer. It had to simulate a feeling of certainty.
I mean, just think about that for a second. This incredibly powerful machine, this pinnacle of data processing, couldn't win just by crunching numbers. To win, it had to copy a profoundly human, totally non-numerical judgment, confidence. So is that really a machine learning? Or is it a machine learning how to be more like us?
And that really brings us full circle. Numbers are amazing, they're a powerful tool, but that's all they are, a tool. They are never the whole story. It's the context we provide, the inferences we make, the qualitative judgments we apply on top of them, that's where true understanding really comes from.
And that leaves us with one last thing to think about. We spend so much of our time and energy analyzing data, building models, and listening to what the numbers are telling us. But what if the real advantage, the real secret to making better decisions, lies in doing the opposite? What powerful breakthroughs could we find if we started asking, what is it that the numbers cannot tell us?
Today, we're going to dive into a story that really gets to the core of modern finance. See, it's about this huge misunderstanding, a kind of collective amnesia, really. Wall Street jumped on this brilliant mathematical revolution, but somehow managed to forget the giant warning label that came with it. And trust me, this isn't just a history lesson. This is about understanding the ghost in the machine of our entire financial system.
To really get this, we need to go back in time. The year is 1994. We're on Lake Geneva, Wisconsin, this beautiful summer escape for people from Chicago. Just picture it. It's a perfect morning in July. The sun's just coming up. The water is completely still, like glass. And there's that cool morning air. You know, it's one of those mornings that just feels full of promise. So, I'm out on the water with a couple of buddies who are traders. We're in this classic, really well-kept 17-foot ski boat, you know the kind, with a big inboard engine that just roars when you start it. We're just kind of drifting, sipping coffee out of a thermos, and I find out something interesting. The boat we're on, it belongs to my friend Don now, but it used to be owned by our other friend, Richard. So, I had to ask the obvious question. I mean, why would Richard sell a boat like this? It was clearly more than just a boat to him. It was, part of the whole lifestyle, the reward for being successful. And the answer, it wasn't because he wanted a bigger boat or was moving away. No, the answer was a really painful lesson, one that was forged during one of the single most brutal days in the history of the stock market. That's what Don said, pretty quietly. He had to raise a new stake. You see, Richard was an options trader in Chicago, and he had been completely, and I mean completely, wiped out on October 19th, 1987. That's a day that will forever be known as Black Monday. He lost it all. So much, in fact, that selling his prized boat wasn't a choice. It was the only way he could scrape together enough cash to even think about getting back in the game. So how does that even happen, right? How does a professional, a guy whose whole job is managing risk every single day, get caught so totally flat-footed? Well, it turns out he broke the most sacred, the absolute #1 rule of trading. It's the one thing they hammer into your head on your very first day. Live to trade another day. That's it. Simple, right? But it means everything. It means you protect your capital no matter what. You never, ever risk it all on one single bet. I don't care how good the odds look. Richard, an options trader whose entire world revolved around calculating probabilities, got so sure of his models that the Friday before the crash, he made a catastrophic bet. He forgot that a 99% chance of being right still leaves a 1% chance of complete and total ruin. Richard's story is just the perfect gut punch of an introduction for what we're talking about today. His incredibly expensive lesson shows us a universal truth that goes way beyond trading. And it's this: probabilities are powerful tools, for sure, but they are not crystal balls. The world is always cooking up new scenarios, stuff that has never happened before in the data. And those are the moments that change everything. Okay, so let's get into it. Here's our game plan. We're going to build on Richard's lesson and dig into the huge difference between risk and uncertainty. Then we'll ask a key question. Is the market more like a predictable game of dice or a very unpredictable game of poker? From there, we'll uncover the specific warning from one of the founding fathers of quant finance that Wall Street just ignored. And we'll wrap it all up by talking about why human judgment has to come before the numbers always. All right, let's jump into our next section. To really get what happened to Richard, and frankly, what happened to the whole financial industry, we need to understand this really subtle but incredibly important distinction made by an economist named Frank Knight, way back in 1921. So in his big book, Risk, Uncertainty, and Profit, Knight basically said, hey, we're all using the word risk wrong. He suggested we split it in two. Risk, he said, is when the future is unknown, but you can actually calculate the odds. Uncertainty, though, that's for a future that isn't just unknown, it's unknowable. These are not the same thing, not even close. And this chart just nails the difference. Think of it like this. Risk is a world of knowns. It's measurable. You know all the possible things that can happen, and you can figure out the probability for each one. Uncertainty, that's a world of unknowns. It's unmeasurable precisely because you don't know all the possible outcomes. You're dealing with brand new scenarios popping up. So risk is knowing the odds. Uncertainty is not even being sure what game you're playing. Okay, to make this really solid, let's use an analogy that gets right to the point. When you think about the financial markets, should you be picturing a game of dice or a game of poker? Because the answer to that question changes absolutely everything. Rolling a pair of dice, well, that's the textbook definition of risk. It's a closed system. There are exactly 36 possible combinations. The probability of rolling a 7 is always 1 in 6. It never ever changes. But poker? Oh, poker is a masterclass in uncertainty. The math of the cards in your hand is just where it starts. The real game is about psychology. It's about bluffing, reading people, and dealing with a ton of missing information. And that is the absolute key. The second that human beings start betting, making choices based on fear and greed, and just gut feelings, the clean, neat mathematics of risk just falls apart. You've entered the messy, unpredictable world of uncertainty. The odds of drawing a certain card, that's risk. The chance your opponent is full of it and is bluffing their head off, that is pure uncertainty. So yeah, the financial markets are basically the biggest poker game on the planet. You've got millions of players and a near infinite number of cards, stocks, bonds, you name it. The game never ends. And, most importantly, the value of those cards can change in a heartbeat, based on nothing more than a shift in what people believe. The collapse of Bear Stearns back in '08, that wasn't a math problem. It was a crisis of confidence. It was a bluff getting called on a global scale. The numbers didn't change overnight. Belief did. Now, here's what's so wild about all this. The guys who started quantitative finance, the very people who brought all this high-level math to Wall Street, they actually understood this difference perfectly.
And one of them left a very, very clear warning, a warning that was almost completely ignored. So, let's talk about Harry Markowitz. Back in 1952, when he was just a PhD student, he published this paper, Portfolio Selection, and it basically created what we now call modern portfolio theory. His whole idea that you could use math to build an optimal portfolio by balancing different assets, that's the foundation of the entire wealth management industry. It's the reason your financial advisor is always talking about diversification. The guy won a Nobel Prize for it. That's how revolutionary it was. But, and this is a huge but, here's the detail that everybody seems to have just forgotten. Markowitz was crystal clear that his process had two separate stages, and the first stage, the foundation of the whole thing, had nothing to do with math. It was about using your experience and what you see in the world to form beliefs about how things might behave in the future. Only after you do that human, qualitative work, do you move on to stage 2 and plug those beliefs into the math. And here it is, the smoking gun. In the very first paragraph of his Nobel-winning paper, Markowitz lays it out in black and white. He says the process has 2 stages. And then he says, and I quote, "This paper is concerned with the second stage." He's explicitly telling everyone, hey, my brilliant formula is only half the story, and it's the second half. It's a tool that's basically worthless without the first human-driven step. I mean, this just raises a mind-boggling question, right? The entire quant revolution, billions and billions of dollars in trading algorithms, a whole industry of financial models, all of it was built on Markowitz's second stage. They just took the math and ran with it. So what on earth happened to the first stage? How did an entire field that's obsessed with precision just completely ignore the fundamental starting point from its own creator for over 60 years? So let's really think about the consequences of skipping that first step. Because when you ignore the part about forming beliefs and you jump right to the math, you don't actually get rid of human bias. You just hide it. You pretend your model is a subjective machine, when really it's just math that reflects your own unexamined assumptions about the world. You know, there's this old saying in academia, torture the data long enough and it will confess to anything. And that's exactly what happens when you skip step 1. Your belief, whatever it is, maybe that the market always goes up in the long run, drives how you build your model. You can always find historical data to back up what you already want to believe. The math just becomes a very fancy way of patting yourself on the back. And Markowitz himself, he was saying this his whole career. He explicitly said that his models weren't meant to replace human judgment, but to support it. The final call, he argued, always has to include those factors or nuances not taken into account by the formal computations. He built the tool, but he never ever wanted us to let the tool do all the thinking. And so we come all the way back to Richard and his boat. He put way too much faith in the numbers, and he forgot the number 1 rule: live to trade another day. He confused risk with uncertainty. The financial world, by forgetting Markowitz's step 1, did the exact same thing on a massive global scale. They gave up the responsibility of judgment, and they hid behind this illusion of mathematical certainty. So the real takeaway here is this. Every single financial model, every investment strategy you ever hear about is built on a foundation of human belief. And the most important question you can ever ask isn't what do the numbers say, it's whose beliefs am I betting on? And that starts most importantly with your own.
Welcome to The Explainer. Today we're going to tear down a piece of advice that sounds super smart, but might actually be holding you back. We're diving deep into the hidden and, honestly, the essential role that our emotions play in every single decision we make. You've heard this a million times, right? I mean, it's pretty much textbook advice. You see it plastered on ads from giant banks. The idea is simple. To make a smart decision, you have to be cold, logical, completely detached. Emotion? That's the enemy of a good choice.
But what if that whole idea isn't just a little off? What if it's fundamentally, even dangerously wrong? What if the very thing we've all been taught to push down and ignore is actually the one thing we literally can't make a decision without? Let's break this down.
So our obsession with pure cold logic didn't just pop up out of nowhere. It actually has some really deep historical roots. And to get why we're so suspicious of our feelings, we kind of have to go back in time and see how we ended up worshiping at the altar of rationality. Just think about it for a second. Our whole education system, our economic models, they're all built around this one type of thinking: analytical, step-by-step, mathematical. You know the type, the kind of intelligence that gets you a perfect score on a standardized test. We've basically made the mistake of thinking that this one skill is the whole definition of human intelligence. And as we're about to see, that is a huge miscalculation.
Okay, so this debate has been raging for forever. In one corner, you've got the empiricists. They believed all our knowledge comes from what we can see, hear, and touch, that perception is reality. But in the other corner, you have the rationalists, guys like Plato and Descartes, who argued that our senses can trick us and only pure reason can lead to truth. Their big tagline? I think, therefore I am. Well, long story short, the rationalist view basically won out, and that gave us the idea of the perfectly logical rational man that still runs the show in modern economics.
So in our big quest to be perfectly rational, we built these models of how people behave that were based on some ideal, logic-driven machine. The only problem? In doing so, we kind of irrationally ignored something massive, something totally obvious about ourselves.
For decades, the people studying us, economists, psychologists, they've tried to figure us out by looking at just these two things. They analyze what we think, and they watch what we do. And they build these really complex models, trying to draw a straight line from our thoughts to our actions, assuming, that that's the whole story.
But there's a third dimension, a huge, messy, incredibly powerful part of us that was just left out of the equation completely, and that is feeling. This isn't just some little footnote, you guys. This is the missing piece of the entire puzzle.
And of course, we intuitively get that feelings matter. You hear it on the news all the time, right? They talk about investor confidence or market sentiment. But when you look at the formal models, the stuff that actually drives big financial systems and policy, feeling is treated like noise. It's seen as a bug in the system, something that needs to be controlled or minimized, not as a vital stream of information.
And here's the thing, this isn't just some philosophical argument anymore. The hard science is in. Neuroscience is now giving us concrete proof that without our emotions, the entire decision-making machine in our heads just grinds to a total halt.
So remember Descartes and his famous, I think, therefore I am? Well, neuroscientist Antonio Damasio came along and just flipped that whole thing right on its head. Based on his incredible research, he argued that our very ability to exist and reason is rooted not in pure thought, but in our feelings.
Damasio's evidence for this was just wow. It was so powerful and so human. He studied patients who had brain damage in the emotional centers of their brain. Intellectually, they were totally fine. They could analyze a problem, they could list out all the pros and cons perfectly, but they couldn't decide. One patient spent hours, literally hours, debating between two dates for his next appointment, and he just couldn't pick one. Others were totally paralyzed by simple choices, like what cereal to buy. Without the data from their feelings, they were just lost in this ocean of facts, completely unable to make a choice.
And you know what? This isn't just true for us humans. Think about Watson, the IBM supercomputer that absolutely crushed it on Jeopardy! To win, it wasn't enough for Watson to just have all the facts in the world. It had to simulate a human feeling. For every single answer, before it buzzed in, it had to calculate a confidence score. Watson literally had to rely on an electronic version of feeling to make its final judgment call.
Okay, so we've established that we need emotion to make a call. But what does that actually mean for us in the real world? It's time to stop fighting our feelings and start seeing them for what they really are, a critical, non-stop stream of data.
This quote from a major economics journal says it all. Affect, by the way, is just a fancy academic word for emotion or feeling. So what this is really saying is that your thinking brain, your cognitive system, can't actually make you do anything by itself. To get you to act, it has to go through your feeling brain. It's not enough to know what you should do, you have to feel it.
Now this is where things get really wild. A study in 2007 just completely blew up the old idea that feelings are bad for decisions. What did it find? Well, first, people who experienced more intense feelings, get this, they actually had a higher decision-making performance. And second, people who were simply better at identifying and understanding their own feelings also made better decisions. The takeaway is just so clear. Engaging with your emotions, not trying to suppress them, is the actual key to better judgment.
Let's look at a real-world pressure cooker. The date is May 6, 2010. The stock market suddenly, out of nowhere, plummets in just a matter of minutes. The algorithms, the purely rational computer models, were going haywire. It was absolute chaos.
So, right in the middle of this total meltdown, what happened? Some of the human traders, they didn't wait for a computer to spit out an analysis. They had a gut feeling. They sensed that something was deeply, fundamentally wrong, and they acted on it. They hit the kill switch on their automated systems. And that feeling they had, we have a word for it, fear. And in that terrifying moment, fear wasn't some irrational panic that clouded their judgment. No way.
It was the most valuable piece of data they had. It was their best risk manager, screaming at them to get out of the way before the whole thing collapsed. Just like Charles Darwin predicted, emotion was a tool for survival.
So, what does this all mean for you and me? It means we've basically been handed the wrong user's manual for our own brains. We need a new one, a manual that teaches us how to actually operate this incredible machinery in our heads by integrating, not ignoring, our emotional data.
And let's be super clear about this. Our brains aren't broken. The problem isn't that we're hardwired to be irrational. The problem is that we've learned the wrong rules. We've been taught to distrust a fundamental part of ourselves, and it's that bad instruction that leads to poor judgment calls.
So here it is, your new playbook. First, just acknowledge what you're feeling, don't push it away. Second, calibrate. Figure out where you are on that internal spectrum. Are you feeling anxious or way overconfident? Third, use that feeling as data. Ask yourself, what information is this emotion trying to give me? And finally, fourth, make your judgment by blending that emotional data with your rational analysis. That's how you get the full picture. And that brings us to maybe the most powerful takeaway of all. That old saying about the only thing to fear is fear itself, it's wrong. When you're facing real uncertainty, the most dangerous thing you can be is completely detached. A total lack of fear isn't a sign that you're confident. It's a sign you're missing critical data.
So this leaves us with a new question we have to ask ourselves. The next time you've got a big, important choice to make, don't just ask, what do I think about this? Take a second, go one step deeper, and ask yourself, what is my gut, my feeling, really telling me? Because that might just be the most important piece of information you have.
Welcome to The Explainer. Today, we're really getting into the head of a modern trader. We're following him on this drive from the Midwest back to Wall Street. But it's not just a road trip. It's really a journey through the fundamental conflict at the heart of today's markets. Is it all about the math, or is it still about the human mind? All right, so here's how we're going to break this all down. We'll start with our trader at a crossroads. Then we'll dig into this really cool idea of the human leap that goes beyond just numbers. After that, we'll see a perception trap play out in a wild story, ask how all this applies to the new digital trading world, and wrap it all up with a final bid that puts everything to the test. Okay, so picture this. Our guy, Michael, is packing his life into a U-Haul. He's driving from Chicago back to the big leagues on Wall Street. He's landed this amazing job at a top-tier bank. But the whole drive, he's just wrestling with this deep uncertainty. You know, the markets have completely changed. It's all about algorithms and high-speed computers now, and he's seriously wondering if his future is just about building the models that trade, not actually trading himself. And this, right here, is the question that's just eating at him on this long drive across the country. What's the right tool for the job now? Should he double down on his math cred, focus on the hard data, the quantitative models? Or is there a hidden, more powerful edge in looking at the market through a psychological lens? This really lays out his dilemma perfectly. On one hand, you've got the quantitative path. It's comfortable, right? It's models, tangible numbers, stuff you can prove. As he puts it, it just sounds inordinately easier. But then there's this other world. This idea introduced to him by a lecturer named Denise Shull, and that's all about the messy stuff, beliefs, human judgment, emotion. It's fascinating, for sure, but way harder to get your arms around. So the thing is, Michael's not totally alone in thinking about this stuff. His friend Renee, who's an options trader, she introduces him to this powerful concept that comes straight from the old-school, chaotic trading floors of Chicago. This little piece of wisdom comes from her dad, Christopher. Now, this guy was a veteran of the trading pits, a real legend who made money in all kinds of markets. And his whole philosophy was that data will only get you so far. At some point, analysis stops, and something else has to take over. So what is this leap we're talking about? Well, it's not just a blind guess or a gamble, not at all. It's this intuitive jump you make after you've done all the math. It's about reading the other people in the market, their fear, their confidence, and then trusting the gut feeling you get from that read to make your move. It's a deeply, deeply human skill. And this is what's really driving Renee, She's obsessed with figuring out why her dad was so successful, especially since he was one of the very few floor traders who made the jump to screen trading and didn't flame out. She's on this personal, psychological quest to figure out what that knack is, to understand the whole psyche, the body, the brain, and the mind, that separates the greats from everyone else. So, to really drive this point home about the power of psychology, Renee tells Michael this incredible story. It has absolutely nothing to do with trading on the surface, but it's the perfect metaphor for a trader's biggest enemy, their own perception. She calls it her water skiing misadventure. Okay, so get this scene in your head. It's sunset in Cocoa Beach, beautiful, right? Renee is water skiing and she takes a tumble. No big deal. Her friends circle the boat around to grab the skis she dropped, and then she hears the engine just sputter and die. And just like that, the boat is drifting away, she's out of shouting distance, and she is totally alone in the water as it's getting dark. Her only option is to swim for this tiny, distant neon lobster sign on the shore. So she starts swimming. She's doing it in intervals, right? Swims for 5 minutes, checks her position against a hotel on the shore, swims for another 5, checks again. So from her perspective, down there at water level, what did she think was happening? How was she doing? Well, she came to the conclusion that she was in serious trouble. From her point of view, it looked like the current was just too strong. She honestly believed that, at best, she was just treading water. And at worst, she was actually getting pulled farther out to sea. It felt completely hopeless. And here's the crazy part. She was totally wrong. Her friends on the shore could see her the whole time, and she was making slow but steady progress. But her belief that she was failing, a belief that was formed by her skewed perspective from down in the water, that belief changed everything. It caused her to stop, to change her strategy, to aim for different landmarks. And all those bad decisions, based on bad information, cost her an extra hour and a half in the ocean. Okay, so that story is pretty intense, right? And it brings Michael's thoughts right back to where he started. If human perception can be that powerful and that wrong, how in the world does that factor into the modern market, where you can't see anybody, where the old trading pit is now just a bunch of screens? Even Renee's dad, Christopher, the guy who lived and breathed the trading pit, he admitted it. He said when the whole game moved upstairs to the screens, it got way, way harder. That human read, that intuitive leap you could make just by seeing the fear or greed in another guy's eyes, that was suddenly almost impossible to do. So you've got this huge divide, right? The old world versus the new one. And this raises the biggest question for Michael's entire career. Have things like high-frequency trading and complex algorithms made those old skills totally obsolete? Is that old art of tape reading, of feeling the human rhythm of the market, is that gone forever? Is his job really just going to be, like he fears, a robotic arm operator? And then, just when you think it's all about the math, science throws a massive curveball. Michael remembers this study he brought up in his job interview from a group of Italian academics. They built the most realistic simulation of a market ever. And what was the secret ingredient? It wasn't just logic and numbers. It was sentiment. They actually modeled how feelings and beliefs flowed between different types of traders. And it worked. It looked just like real market data. And it even explained fat tails, those wild, unexpected crashes and booms that happen way more often than traditional models say they should. Turns out, human psychology isn't noise. It's the key. All right, so our journey is almost at an end. Michael finally rolls into New York City. His head is just swimming with all these ideas about math and minds and perception. He walks into his new hire training at the super prestigious Stearns Men Bank, and he is about to get a very practical and very public lesson on this very topic. He's a little late to his first training session, just walks in, grabs a coffee. As he comes through the door, he hears the guest lecturer in the middle of auctioning off a crisp $100 bill to all the other new hires. And the bidding is just heating up. $80, $85, $90. The energy in the room is high, and the price is getting closer and closer to the actual value of the prize. To him, it just looks like a fun little game to see who can get the best deal. So Michael, thinks he's being clever. He sees an easy $5 for his coffee. Without hesitating, he just confidently shouts out, 95. He's sure he's made a smart play. And then the room kind of chuckles, and he realizes he's missed something. And boom, there it is. The trap. The one tiny, crucial detail he missed because he walked in late. In this auction, the second highest bidder doesn't just walk away empty-handed. No, they have to pay their bid to the winner. So when someone else inevitably bids 100, Michael wasn't about to win $5. He was about to lose 95. His entire perception of the game was completely, painfully wrong. And for the final, just perfect, ironic twist, the guest lecturer running this whole masterclass in psychological traps and flawed perception, you guessed it, it was Denise Shull, the very same person whose ideas sent Michael down this rabbit hole in the first place.
And that just leaves us with this one big question, doesn't it? Michael's entire journey, ending with him falling face first into that auction trap, it just shows that understanding these psychological forces is one thing, but actually mastering them is something else entirely. I mean, if he could fall for that while these ideas were so fresh in his mind, it really forces you to stop and ask, where are our own blind spots? What are the crucial rules we're missing in the games we play every single day? So, let's get right into it. We're tackling a really big question today. To handle the crazy, unpredictable nature of financial markets, do you basically need to be psychic? It sounds a little nuts, I know, but stick with me, because by the end of this, you might just find that the best traders have a skill that's a lot closer to mind reading than you'd ever guess. And it really all boils down to this one single idea. This sentence right here, it pretty much flips the script on everything we're taught to believe about finance. It says that all the math, all the data, all those complex spreadsheets, they're all aimed at the wrong thing. The real game isn't figuring out what an asset is worth. The real game is figuring out what other people will think it's worth down the road. So first up, let's just tear down the biggest myth out there. We're going to peel back the layers on what the market game is actually about. And I'm willing to bet it's not what you think. I mean, this is the story we're all told, right? From day one in business school, on every financial news show, we're trained to see the market as this giant, complicated, but ultimately solvable math problem. You know, if you can just get enough data, find the perfect formula, you can crack the code, find the truth, and win. But what if that's all wrong? What if all those facts and figures, all that data, isn't the answer at all? What if it's just a trail of breadcrumbs leading to the real puzzle, which is way more complex and unpredictable, predicting what other people are going to do? See, that changes everything. Suddenly, success isn't about objective analysis. It's about getting good at predicting human perception. Now, to really wrap our heads around this, we have to go back in time to a kind of weird place, a newspaper game from the 1930s. And trust me, this isn't just some random history lesson. This is a brilliant insight from one of the sharpest economic minds ever, John Maynard Keynes. Okay, so here's how it worked. Back in Keynes's day, a newspaper would publish, say, 100 photos of different women, and the readers had to vote for the 6 they thought were the prettiest. But here's the genius twist. You didn't win by picking the faces you personally found most attractive. No. You won by correctly guessing which 6 faces would get the most votes from everybody else. Your opinion was totally irrelevant. And this game just perfectly shows the different levels of thinking. Level 1 is easy. I like this one. That's your personal opinion. Level 2 is a little smarter. Okay, what is the average person probably like? But Keynes pointed out that the real winning strategy is on level 3. Trying to figure out what the average person thinks the average person will pick. It's a game of guessing other people's guesses. And that right there is the killer insight for the market. Your deep, fundamental analysis of a company's balance sheet, that's just a level 1 guess. It doesn't really matter. What really matters is predicting the future perception of that company's value. You're not trading the stock. You're trading the story that other people are going to tell themselves about that stock tomorrow, next week, or next year. So if that's true, it also totally changes how we should be looking at the numbers themselves. We tend to treat them like these solid, objective facts, but honestly, they're way more like smoke and mirrors. You know, we're taught to think of numbers like they're laws of physics. 2 + 2 is always 4. It's absolute, it's fact. But in the market, numbers act a lot more like a language. Their meaning changes depending on the context. You know, like how the word fixture means a faucet in the US, but a soccer schedule in the UK. A stock price of $100 means one thing to a buyer and the complete opposite to a seller. It's all about perception. This quote from the source material just nails it. A stock price isn't some fundamental constant of the universe. It's just the temporary spot where a buyer's perception and a seller's perception happen to cross paths for a split second. It's a fleeting agreement in an ocean of disagreement. And really, if you think about it, a single objective truth in the market is literally impossible. Prices flicker and change every nanosecond. For every single trade to happen, you need 2 people with the exact opposite point of view on its value. And we talk about things like expected value, but we forget that word expected. It's a guess, not a fact. The future isn't one path, it's a billion possible paths. Okay, so
this leads us to a really fascinating place. If the market is all about human perception and not cold hard math, then what's the actual skill the great traders have? What's this so-called psychic power we mentioned? Well, the answer, believe it or not, comes from cognitive science. Scientists call it theory of mind. Now that sounds super academic, but it's something we all have and use constantly without even thinking about it. It's our built-in ability to imagine what's going on in someone else's head, to guess their beliefs, their intentions, their desires, and what they might do next. And you're an expert at this? I promise. Think about walking down a busy sidewalk. You are constantly, unconsciously running thousands of little simulations in your head, predicting the paths of every single person around you so you don't crash into them. Or when you merge into traffic, you're not just looking at cars as metal boxes, you're trying to guess the intentions of the other drivers. It's an incredibly sophisticated social skill. And here is where it gets absolutely incredible. A huge study out of Caltech actually put this idea to the test. They had people play in these artificial markets, and they found that the people who were best at predicting price moves were also the people who scored highest on standard theory of mind tests. But the real bombshell was from the brain scans. When people were successfully predicting the market, it was the social reasoning parts of their brain that were lighting up like a Christmas tree. The math centers, they were quiet. And this is exactly what legendary traders have been trying to describe for decades, just without the fancy scientific name. When a guy like Stevie Cohen talks about the art to reading the tape, he's not talking about memorizing chart patterns. He's talking about recognizing the patterns of human behavior that are hidden inside the price data. And this is not some newfangled idea either. Go back 100 years. The original trading legend, Jesse Livermore, said the exact same thing. He called the tape his telescope to watch the human battle going on in the market. He wasn't watching numbers, he was watching people. So what's the big takeaway here? What do we do with all this information? It means we need a whole new mental model. We've got to throw out that old market as a math problem idea and replace it with something that actually fits this messy human reality. Our source material calls this the social market hypothesis. Basically, it reframes the market as a social ecosystem, not a mathematical one. Price movements aren't just random noise. They are waves of human perception and emotion. Fear, greed, panic, FOMO, that spread from person to person, driving the whole herd. To really get a feel for this, stop picturing a clean spreadsheet. Instead, I want you to imagine a scene of total chaos, a giant convention hall where 100 different classic cars are being auctioned off all at the same time to 10,000 different bidders. Now, what happens if a rumor starts in one corner that some of those cars are fakes? How fast do you think that fear would spread? That auction model is a perfect way to understand huge events like the 2008 financial crisis. That wasn't a spreadsheet error. It was a social cascade. It started when a few big players basically said, "We're not bidding anymore." That created doubt. The doubt turned to panic. It's like a game of musical chairs where everyone suddenly realizes there aren't enough chairs. Everyone rushes for the exit at once, nobody's left to buy, and prices collapse. That's a liquidity crunch. It's a social phenomenon. So the most important takeaway from all of this is that you have to fundamentally shift your focus. The numbers matter, sure, but they're the symptom, not the cause. You have to actively analyze the human context behind the numbers. What's the mood? What are the other players afraid of? What are they hoping for? The best risk management in the world isn't a fancier formula. It's a deeper understanding of the people you're playing the game with. And that really leaves us with one final big question to chew on. We spend so much time and energy trying to manage risk in the numbers, trying to model the unmodelable. But if this whole entire game is driven by human perception, maybe we've been looking in the wrong place the whole time. Maybe the biggest risk isn't in the data at all, but in our simple failure to understand other people.
All right, let's jump right in. Picture this. You're a brand new hire at some huge bank. You're sitting in one of those conference rooms for a lecture on trading psychology. And the topic for the day is context. And get this, the speaker starts telling you that pretty much everything you think you know about making decisions is probably built on a totally flawed model of how your brain works. So yeah, let's unpack that. Let's figure out how our brains actually make decisions.
So here's where we're headed. First, we're going to completely demolish that old myth of the brain as a computer. Then we'll get into why context is basically the king of all meaning. After that, we'll break down the huge difference between simple risk and, real-world ambiguity. Then we'll find the exact part of your brain that's built for that uncertainty.
And we'll wrap it all up with a really powerful takeaway that might just change the way you make judgments for good.
Okay, first things first. For, I don't know, decades, we've had this one go-to analogy for our minds. The brain is like a computer. Simple, right? But what if that's not just a little bit wrong, but fundamentally misleading?
I mean, this seems like the easiest question on the planet, doesn't it? It's just pure logic. It's a universal truth. But what if I told you that the answer to that question is actually no?
It's wild, but it turns out even something as basic as 2 + 2 = 4 gets processed differently depending on where you grew up. Research shows that native Chinese speakers and native English speakers literally use different parts of their brains to get to the exact same answer. So much for a universal thinking machine, huh? Our thinking is shaped by our culture, by our language, all the way down to the neural wiring.
And a discovery like that just completely blows up all those old, really simple models of the brain. You've probably heard of the lizard brain, right? This idea that we have this ancient emotional part of our brain that's always fighting with our modern rational mind. It's a great story, but honestly, it's decades out of date. The truth is, our brains are way more dynamic and interconnected than those tiny little boxes ever suggested.
So the new model that's replacing all that is called the embodied embedded model. Now, that sounds super academic, I know, but the idea is actually pretty simple. Your mind isn't just software running in your skull. Thinking is a full-body sport. It's constantly being shaped by your physical state, if you're tired, if you're hungry, and by your environment in this constant feedback loop. That whole idea of a trader being some cold, detached machine, it's not just a bad idea, it's biologically impossible.
So, if the brain isn't just a simple input-output machine, then what is it? Well, that brings us to the real hero of our story today, context. Because if your brain is constantly talking with the world around it, then the meaning of everything it sees and hears, well, that becomes the whole ball game.
And you know, this isn't some brand new idea. A philosopher named Gottlob Frege nailed it over 100 years ago with what he called the context principle. And here's the beautiful irony. He first wrote about it in a book on arithmetic, the one field you'd think would be totally immune to context.
Just look at this number on the screen, 10,000. That's it. Right now, it's just pixels. It has no feeling, no story, no good or bad attached to it. It just exists. It's totally neutral.
To give it any meaning at all, your brain just instantly starts firing off questions. 10,000 what? Dollars? Miles? Likes on a post? Is that a big number or a small number? You can feel that something's missing, right? That's your brain screaming for the most important ingredient of all, context.
And this table just illustrates the point perfectly. Let's say I tell you the Dow Jones is at 10,000. What does that mean to you? Well, if it just climbed up from 8,000, then 10,000 is fantastic. It's a bullish recovery. But what if it just crashed down from 20,000? Then 10,000 is an absolute disaster, a bearish collapse. It's the exact same number, but with completely opposite meanings. The fact itself means nothing without the backstory.
Okay, so if context is everything, what happens when that context gets fuzzy or incomplete or it's constantly changing? To really get that, we need to understand how scientists draw a line between two very different kinds of uncertainty.
Okay, so on one side, you've got risk. This is any situation where you know the odds. Rolling a die is the classic example. You know for a fact there's a 1 in 6 chance of rolling a 4. You have all the info you need. But on the other side, you have ambiguity. And this is the real world. Buying a stock, leading a company, making a big life choice. The probabilities? Who knows? The data is incomplete, and you have to somehow interpret what little you can see. And a neuroscientist named Minghas Shu actually discovered that our brains handle these two things in completely different ways. When we're faced with ambiguity, a very specific uncertainty circuit lights up. It's like a big red warning light in your head that starts flashing, "Warning, the context is dangerously unclear. We need more information."
And this, right here, is exactly why that famous trading advice, plan the trade and trade the plan, is so ridiculously hard to follow in real life. That saying treats the market like it's a simple risk problem, like a dice roll. But the market isn't risk, it's pure, deep ambiguity. So while your logical brain is trying to stick to some rigid plan, your ancient survival hardware is screaming at you to find more information, to adapt to a context that it knows is changing by the second.
It's like a quarterback in a football game. Yeah, he has a game plan. Of course he does. But that plan is a framework. It's not a script he has to follow no matter what. The second he sees a defender break through the line, he's not thinking about the plan. He's reacting. He's adapting. He's making a split-second judgment based on the brand new context. You can't win a football game by treating it like a math problem, and you sure can't win in the markets that way either.
So this brings us to what is, for me, the most amazing part of this whole story. It turns out your brain doesn't just know the difference between risk and ambiguity. It has a specialized high-speed engine designed specifically to thrive in that fog of ambiguity.
A researcher named Scott Hudel calls this the brain's jigsaw puzzle mode, and it's a perfect analogy. When you're faced with a confusing, ambiguous situation, your brain doesn't just freeze up. It instantly starts scanning its massive library of memories for any little piece that might fit. Patterns, shapes, feelings, anything. It rapidly test-fits thousands of possibilities until finally it snaps together a story, a working context that makes sense of the messy, incomplete picture in front of you.
And get this, neuroscientists have actually found the hardware. It's a little region called the PIFS, and it's located right beneath your temples. This part of the brain doesn't just tolerate uncertainty, it thrives on it. When you're wrestling with a really tough, ambiguous problem, the PIFS lights up like a Christmas tree. I mean, is it any wonder that when we're deep in thought, we all instinctively rub our temples? We're literally massaging the part of our brain that's doing the heavy lifting.
Okay, now you're going to want to sit down for this one. This is the big reveal. The research shows that this uncertainty engine we've been talking about, this context-building machine in your head, it actually works faster than the parts of your brain that do simple, logical math. I'm serious. Let that sink in for a second. Your brain is literally faster at figuring out a fuzzy, ambiguous situation than it is at solving 2 + 2. And why? Well, it's simple, really. For millions of years of evolution, what was life? It was one big, ambiguous situation. Ambiguity was the rule, not the exception. The survivors, our ancestors, they were the absolute masters of context.
So, after all that, what's the bottom line? What does this all mean for you? How do we take all this cool neuroscience and actually put it to work in our everyday lives, in our own decisions?
Well, let's recap real quick. We've tossed out that old idea of the brain as a computer. We know that context is what gives anything meaning. And we've seen that uncertainty isn't some rare event. It's the absolute rule of life. And most importantly, we know that your brain has this amazing, specialized, high-speed engine built for exactly that kind of world.
And here it is. This is the key takeaway. Your real edge, your real power as a decision maker, it isn't just in being able to crunch the numbers. It's in mastering what the source material calls the meaning gap. That's the space where the data ends and your judgment has to take over. The goal isn't to fight your brain's nature, it's to work with it. It's to become relentlessly intentional about defining and truly understanding the context that you are in.
Look, you can't control all the variables. You are never going to eliminate ambiguity from your life. But by embracing your brain for what it actually is, this incredible context-seeking machine, you can shift your focus. You can stop trying to predict the unpredictable and start focusing on mastering the situation you're in right now. Because at the end of the day, you can't control the market. But maybe, just maybe, you can master your context.
All right, let's dive right in. We're heading into what you could call perception's labyrinth. We're going to uncover how the hidden architecture of your own mind, yeah, your mind, builds the financial reality you're trading in every single day.
So picture this. The year is 2011, August. The air is just thick with tension. You can feel it. The market is teetering on a razor's edge, and pretty much everyone is holding their breath, waiting for, well, they don't even know what.
I mean, it is pure chaos. The Dow had just dropped 500 points the week before, and now it's playing this insane 400-point ping-pong game. To top it all off, Standard & Poor's has just downgraded U.S. debt for the first time in history. Nobody has a playbook for this. No one even remembers what this is supposed to mean. And then you've got European central bankers making these cryptic statements. It's a complete and total vacuum of context.
So, that brings us to the big question, right? When you're staring down a storm of information that's completely new, totally unprecedented, how do you even begin to make sense of it? How do you build that mental framework to navigate through it all? Forget thriving. How do you even decide what your next move is?
Okay, so to get to the bottom of that, here's our roadmap. We're going to kick things off with the perception problem in markets. Then we'll look at our inside versus outside worlds. We'll see how your beliefs basically curate your reality. Dig into the feeling factor. And then, the big one, how we actually see with feeling to play the real game. Let's get into it.
All right, Section 1, the perception problem. You ever wonder why making decisions in financial markets feels so draining? Why it's one of the most psychologically demanding things you can do?
Well, it all boils down to one simple but absolutely relentless fact.
So there was this fascinating conversation with a Special Forces agent. And you'd think, okay, their job has the ultimate risk, right? Life and death. But here's the thing. Military decisions have a certain clarity. You know when you're on base versus when you're in enemy territory. The objective is brutally clear. Kill or be killed. And there's an end. There's finality. But the market? Oh man. In the market, time frames are a complete blur. Your objectives can change minute by minute. And an asset that's your best friend one moment can become your worst enemy the next. The final whistle, it never, ever blows.
Okay, so if the market is this never-ending, confusing game, where on earth do we get our sense of understanding from? You know, that mental context we need to even play. Well, it turns out the answer lies in two very different but totally interconnected worlds.
Yeah, we build something called context. It's basically the mental framework we use to organize all the new stuff coming at us. You can think of it like the filing system in your brain. It's how you make sense of the world, and it's built from two and only two key sources.
So, on one side, you've got the outside world. That's your situational context. That's the S&P downgrade, the news flashing on TV, the charts and data right in front of you. But then there's the inside world. That's your internal context. And that's made up of your memories, your beliefs, your expectations, all your past experiences, everything that makes you, you. So, the million-dollar question, which one matters more, the outside stuff or the inside stuff? It's just like that old nature versus nurture debate, isn't it? For decades, people went back and forth, arguing for one side or the other, until finally, the scientific community kind of threw up its hands and said, you know what? The answer is both. Your perception isn't one or the other. It's this inseparable blend of what's happening out there and what's going on inside your own head.
But here's where it gets really interesting. This is not a passive process. Your internal world, and specifically your beliefs, are like a bouncer at a club. They're actively filtering and curating what you even get to see from the outside world.
Just think about this for a second. Let's say you have to forecast a stock's price. A chartered financial analyst, a CFA, is going to dive right into projecting company cash flows and demand curves. It's what they do. But a certified market technician, a CMT, they're going to ignore all that fundamental stuff and go straight for the historical price charts and patterns. They're both looking at the exact same problem, but their training, their beliefs, send them down two completely different, mutually exclusive roads right from the get-go.
So what does this mean? It means your beliefs are the gatekeeper. They don't just interpret reality, they actually restrict it. They're the ones deciding what information is important and what's just noise to be ignored. They are literally constructing the world that you perceive. And just when you think you've got it, we go a layer deeper. Because it turns out there's this surprising, totally inseparable link between what you believe and what you feel. I mean, think about it for a second. Can you really, truly believe something if you also have a gut feeling that it's wrong? No way, right? Of course not. A belief isn't just some cold, detached thought. A belief is a thought that's been charged up with the feeling of certainty. Without that feeling of, yeah, this is right. It's just an idea, a hypothesis. It's not a belief.
Okay, so if beliefs and feelings are tangled up like that, how stable are they really? How solid is that feeling of certainty? Because what if I told you that your financial risk tolerance, that gut feeling, could be manipulated with, frankly, shocking ease?
The research on this is just mind-blowing. Seriously. Studies found that if you show people a picture of rotten food, or even an erotic picture, right before they have to make a financial choice, it unconsciously changes how much risk they're willing to take. Get this. Other studies found that just holding a hot cup of coffee versus a cold one can influence your judgment of other people. The feelings from one totally unrelated thing literally bleed over and color your perception of the next.
And all of this leads us to what might be the single most important insight we're going to talk about. For our entire lives, we've been taught that emotion is the enemy of good decisions, right? That it's a distraction from clear-headed perception. Well, the truth is the complete opposite. Emotion is a necessary ingredient for perception.
You just have to hear the story of Michael Moy. This man lost his sight when he was just 3 years old. Then, at age 40, a transplant actually restores it. But he couldn't see. All he saw was a meaningless jumble of shapes and colors. He had to slowly, painstakingly learn to connect the signals his eyes were sending with emotional meaning, just to be able to identify what he was looking at. He had to become, as the source says, fluent in vision. His brain literally needed emotional input to make sense of the visual data.
The author of this piece experienced this in a terrifyingly real way. He's walking up a subway staircase, and suddenly, a 300-pound guy starts tumbling down right at him. And in microseconds, faster than you can blink, his arm shoots up to block the guy's foot, his other hand grabs the railing for support, and he braces for impact. Boom. He's safe. It was only seconds later that his conscious brain finally caught up and was like, wait, how did I just do that? His mind saw the image, felt the threat, and acted, all before he was even aware of it.
Okay, so what in the world does all of this mean for us, for traders, in the real world? Well, if you take these insights seriously, it means you need a whole new playbook.
Yeah, this really sums up the whole paradigm shift. The old way of thinking, the old game, was that you're playing a game of numbers. Your goal is to find the correct data, and emotions are the enemy you have to crush. But the new game, the real game, is a game of perceptions. Your goal isn't to find the right data, it's to clarify your own perceptions. And emotions? They're not the enemy. They are the raw material that allows you to see the game board in the first place.
And this has real practical consequences. You know the phrase, seeing red? Well, research has proven it's not just a metaphor. The color red literally increases the speed and force of our movements. So think about that. If your trading screen flashes bright red every time you have a loss, it could be triggering an impulsive reaction before you even have a chance to think. Maybe it's time to change your P&L colors to, yellow and purple.
So let's just end on this thought. Your whole life you've been told to suppress your emotions, to ignore them, to make better, more rational decisions, right? But what we've just seen is that you literally cannot see without them. Not the world and definitely not the market. So if that's true, doesn't that mean we've been playing the game with a fundamentally wrong rulebook? Doesn't that mean we need an entirely new strategy?
All right, let's get right into it. For basically our entire lives, we've been told that to make smart, high-stakes decisions, you have to be cold, you have to be logical, totally rational. But what if I told you that's all wrong? Completely backward. What if the very thing we've all been taught to push down and suppress, our feelings, is actually our single greatest asset for managing risk? Yeah, this explainer is going to flip that old idea right on its head. And this quote right here, this is where it all starts. Just think about it for a second. We're so quick to blame our emotions, right? We say fear made me sell at the bottom, or greed made me buy at the top. But this quote, it makes you ask a really simple but profound question. Can a feeling all by itself actually do anything? Can the feeling of anxiety physically click a mouse? Can panic place a trade? The answer, of course, is no. And that one simple fact, well, it changes absolutely everything. So here's our game plan for today. First, we're going to completely tear down that old myth of logic versus emotion. Then we're going to get really clear on separating the act of feeling from the act of doing. After that, I'll introduce you to a really powerful new model called the emotional context theory. We'll see it in action with some crazy high-stakes examples. And then finally, we'll wrap it all up by showing you how to turn this into your own personal secret weapon. First things first, we have to tackle a myth that is so woven into our culture, it's basically invisible. You see it everywhere, from Wall Street trading floors to the Super Bowl. It's this unquestioned belief that to win, cold, hard logic has to crush our messy human emotions. We're all taught to trust the Spock in our heads over the Kirk. And this is the classic showdown, isn't it? It's the battle that plays out in our heads all the time. On one side, you've got Spock. Pure logic, reason, control. He's the ideal we're told to strive for. And on the other side, you've got Captain Kirk, running on gut feelings, intuition, and, well, a whole lot of human emotion. But here's the funny thing, isn't it? Even in the show, when things got really bad and the toughest calls had to be made, who did the entire crew look to? It wasn't the computer. It was the human. It was Kirk. And look, this isn't just some pop culture thing. This belief is deep. It's an axiom we've built our society on. We put logic up on this huge pedestal, believing that math and pure, cold reason are our most powerful tools, especially when the pressure's on. The mantra we hear over and over and over is, get your emotions under control. But here's the massive paradox in all of this. Modern neuroscience has shown us pretty conclusively that without our feelings, we literally can't make decisions, like at all. People with certain types of brain damage who can't feel emotions become paralyzed by choice. So feelings are a required fundamental part of the system, which leads to a wild question. If our brains depend on feelings to function, isn't trying to suppress them the most irrational thing we could possibly do? Okay, so that question leads us right to the heart of the matter.
To really deconstruct this myth, we have to pull apart two things that we almost always mash together. We mistakenly treat two completely separate events as if they were one and the same.
Let's just be super literal for a second. Can the feeling of fear, all on its own, pick up a phone and scream sell to a broker? Can the feeling of pure greed physically type an order into a keyboard? Of course not. It's impossible. An emotion has no hands, no voice. It can't do anything in the real world.
So this is the crucial insight. Feeling something and doing something are two totally distinct psychological events. There's a space between them. First, you experience a feeling. Could be anxiety, could be frustration, could be overconfidence. That's step one. Then, and only then, you might take an action. You type on a keyboard, you make a call. That's step two. But here's the key. Step one does not have to cause step two. They are separate.
You see what this means? It means we've been fighting the wrong battle this whole time. We don't need to control the feeling of fear. We need to control the action of panic selling. The feeling itself is just data. It's a signal. It's our physical response to that signal that we need to manage. And that is something we absolutely 100% can control. Okay, so if we stop trying to fight our feelings, what do we do instead? Well, this brings us to a really powerful new way of looking at things. It's a framework that finally makes sense of all that so-called irrational behavior that economists and psychologists have been talking about for decades.
Let me introduce you to the core concept, emotional context, or just EASY for short. The idea is actually pretty simple. Since we know feelings are required to make a decision, then it follows that every single decision we make is being fueled by some kind of feeling. And when you start to understand that emotional context, behavior that looks completely irrational from the outside suddenly starts to make perfect logical sense.
And listen, this isn't just some nice-sounding idea. It's backed by some serious science. A pioneering neuroscientist named Antonio Damasio discovered that our emotions and feelings are literally the bridge connecting our rational and non-rational brain processes. They aren't a bug in the system. They're a critical feature.
So trying to make decisions while you're actively ignoring the emotional data your brain is feeding you is, well, it's just fundamentally absurd. I love this analogy from the source material. It's like trying to grow a garden by slathering all your plants in SPF 50 sunblock. You're intentionally blocking a vital input that's required for growth. You can't be surprised when all you end up with are some very weird mutant vegetables. Okay, so enough with theory. Let's see how this stuff actually plays out in the real world, right? When the stakes are incredibly high. We're going to look at two pretty fascinating case studies that show the huge impact of understanding, or in one case, failing to understand, your emotional context.
Let's go back to the 2008 financial crisis. As the decision to save Lehman Brothers was being debated, a very senior official wrote in his notes that he couldn't stomach another bailout because it would be horrible in the press. Now, think about that phrase, couldn't stomach. That is not a financial term. That's a feeling. That's a gut-level, physical, emotional reaction. And that emotional context, the fear of public anger and bad headlines, overrode all the logical arguments about systemic risk and led to a decision that helped trigger a global catastrophe.
Now, let's look at a much more personal story. This quote is from a professional trader, and it describes a problem I'm sure a lot of us can relate to. He feels this anxiety about losing the money he's made, so his action is to sell out of a winning trade way too early. And then he just has to sit there and watch in frustration as it keeps going up without him. His feeling is consistently leading to a poor action.
So what was the advice he got? You'd think it would be more disciplined or control your fear. But no, the advice he got was to do the exact opposite. He was told not to suppress the fear, but to analyze it, to treat it like a valuable piece of data. He was literally told to get out a piece of paper and write down in detail exactly what that fear and doubt felt like in his body.
And the result? 6 months later, he reported back that his profits had improved significantly. Why? Because by treating his anxiety as a signal to be decoded, not a nuisance to be silenced, he was able to create that space between the feeling and the action. He didn't get rid of the fear, he just learned to listen to its message and then control his response. And that led to much, much better outcomes.
Okay, this brings us to the final and I think the most important part. How do you turn all this theory into your own secret weapon? Let's talk about how you can transform what seems like a fleeting, ephemeral feeling into concrete, usable data that you can actually work with. You have to remember this. It's absolutely crucial. Feelings are not a flaw in our wiring that only shows up when we're under pressure. They are the very tool our brain evolved to navigate uncertainty. When the path forward is foggy and the data is ambiguous, our brain doesn't shut down our feelings. It leans on them more heavily to try and make sense of it all. So what's the new path forward? It's actually a pretty simple two-step process. Step 1, manage risk. Just by becoming aware of your own emotional context, your EC, you will dramatically reduce the number of stupid, unforced errors you make. Step 2, seize opportunity. Once you get good at reading your own emotional data, you get so much better at reading the collective EC of the market. And the bottom line is simple: you make fewer bad decisions, which means you're always in the game, ready for the next opportunity.
I absolutely love this way of thinking about it. Think of this skill not as some kind of superpower, but more like a vaccine. Understanding the emotional context, your EC, that you bring to any big decision is like a psychological inoculation. It vaccinates you against those impulsive, catastrophic mistakes that can take you out of the game for good. So let's just end with this thought. Your feelings are not random noise. They're not a distraction. They are a constant, rich, and absolutely vital stream of data that your brain is serving up 24/7 to help you navigate the world. For far too long, we've been told to just turn the volume down, to ignore it. The real question is, are you ready to finally start listening?
Welcome to The Explainer. Today we're diving into an incredible story about how a major career crisis led to, well, a game-changing discovery in the financial markets. It's a journey that literally goes from a high-stakes Wall Street desk all the way to the snowy slopes of Aspen, where a forgotten secret would change pretty much everything.
You know, for most of us, that is a terrifying thought. But for a trader we'll call Michael, this wasn't just some hypothetical question. In January 2012, this became his reality, and it ended up setting him on a path that he never, ever could have seen coming.
All right, so let's set the scene. It's New York City, January 2012. Our guy, Michael, is at a huge crossroads. He's just gotten back to his desk at Stearns & Bank after the New Year's holiday, and boom, he's called into a meeting where a memo is waiting, and the subject line basically says it all: regulations against proprietary trading by banks.
And just like that, his job was gone. See, new regulations meant the bank couldn't do what's called proprietary trading anymore, which is really just a fancy way of saying they couldn't trade the bank's own money for profit. And after just 6 months in that role, Michael was suddenly facing a choice that would define his entire future.
And his options, as you can see, were like night and day. On one hand, he could play it safe. Apply for a traditional banking job, something he called utterly boring, a corporate container. Or he could take the severance package, which gave him about a year's worth of cash to live on, and just leap into a completely uncertain future.
Now this is what made Michael different. He wasn't just a numbers guy. No, he was fascinated by the human element, the thing that was really driving the markets. He truly believed the secret edge wasn't in some complex algorithm, but in understanding the psychology, the beliefs and perceptions of all the other traders out there. And that insight, well, that would become his North Star.
So feeling totally adrift, financially stressed, he did something that was completely out of character for him. He made this impulsive decision that would take him so far from Wall Street, it would end up changing the entire course of his life.
And it all started with a super simple text message. A text to his brother Tom, who was out in Aspen, Colorado. He saw some cheap January airfares, figured he could pick up shifts working the ski lifts on the mountain, and he just went for it. He literally decided to trade his Wall Street suit for a ski jacket.
I mean, just look at this timeline. It really shows you how incredibly fast his life got turned upside down. In just 1 week, his whole world flipped. He went from analyzing overnight market action in New York to navigating blizzard conditions in Aspen, where his biggest worry was no longer the market, but how much of Bell Mountain he could possibly ski in a single day.
But it was in Aspen that a chance connection, through his friend Renee, led to this absolutely fateful encounter. He found himself skiing with her dad, Chris, and Chris's tight-knit crew of old-school floor traders who were in town for their annual trip.
And let me tell you, these guys were living legends from a totally different era of trading. They were the real deal. Veterans from the chaotic trading pits of the 1980s, the Chicago Merc and the CBOE,
where fortunes were made and lost face to face, screaming and shouting, and they all shared this deep sense of nostalgia and a real frustration with the modern electronic market.
You see, in their view, the magic was just gone. That human element they relied on in the pits, the ability to actually see the fear and greed in another trader's eyes, was completely lost when everything moved to the screen. To them, it was a totally different game, and they weren't so sure it could be won in the same way anymore.
Listening to them talk sparked this critical question in Michael's mind. If these absolute legends of the industry felt lost, how could an independent trader like him, with hardly any capital, possibly succeed in this new electronic world? So that night, over dinner, he decided to just ask them straight up.
He just laid it all out there. He explained he didn't have the backing of a big bank anymore and just asked for their insight. And what they shared with him next would become the absolute cornerstone of his new trading philosophy.
This was the first lesson, and it wasn't just a tip, it was a profound shift in mindset. They told him, you can never, ever forget that you aren't trading charts or numbers, you are trading other people and their perceptions of the world. A chart, they said, is a living, breathing representation of human behavior. It's a map of decisions, of fears, of hopes.
And then they introduced him to this incredibly powerful tool, a concept that was developed by a legendary trader named Peter Steidelmeier. It's a method for looking at trading volume, but with this one critical twist. You don't look at it by time, you look at it by price. This idea, volume at a price, completely changed how Michael saw the market.
And this chart here, this visualizes that exact concept. As Chris explained to him, this isn't just a bunch of data. It is a pure way of seeing people through the chart. Each of these horizontal bars shows you how much trading happened at one specific price. It literally reveals the exact levels where traders cared enough to do a ton of business.
Okay, let's break this down a little more. The normal way to look at volume is based on time, right? It just shows you when everybody rushes in or out. But this deeper way, volume at a price, it shows you where they were willing to trade. It reveals the market's memory, the exact price levels that hold real psychological importance, which gives you massive clues about where future battles between buyers and sellers are most likely to go down.
Well, Michael's intuitive grasp of this whole concept, plus his thoughtful questions, it all left a major impression on these veteran traders. And on their very last ski run of the day, high above the mountain in a gondola, his life was about to change all over again.
Chris, the veteran trader, told Michael he saw his whole approach to skiing as a perfect metaphor for a great trader. He saw a blend of technique, someone who really respects the fundamentals, but also has this willingness to just go for it once all the facts are in. In Michael, he saw the perfect mix of art and science.
And this is where Michael's crisis completely transformed into the opportunity of a lifetime. Turns out, the old guard wanted back in the game, so they offered to put up millions of dollars to back Michael's very own trading fund, giving him the capital and the mentorship he so desperately needed. The conditions? He had to move to Chicago, and one of them had to have a management role. It was, simply put, an offer he couldn't refuse.
I mean, he said yes in a heartbeat. Who wouldn't? With the backing and mentorship of these legends totally secured, the final pieces of his new venture just fell into place with this incredible speed. All that was left was to find a name.
And his friend Renee, the one who made the introduction in the first place, she came up with the perfect name. It was bold, it was provocative, and it just perfectly captured the spirit of their entire approach to the markets.
The name was basically a declaration of war. They were staging a coup d'etat, an overthrow of the old rational way of thinking that saw markets as just cold probabilities. Their new regime was going to put human psychology, perception, and emotion right at the center of everything, exactly where Michael always believed it belonged.
So in the end, Michael's greatest crisis turned out to be his greatest opportunity. It just goes to show you that sometimes the end of a path you thought was the one isn't really an ending at all. It might just be the start of a much more interesting journey, one that's waiting just behind an unexpected door. It really makes you wonder, doesn't it? Where is yours? Thanks for watching.
Today, we're diving into a really powerful idea, something that could completely change how you approach high-stakes situations, especially in the financial markets. It's all about mental capital and psychological leverage, basically a secret weapon, an edge you can control that most people don't even know exists.
You know the feeling, right? We've all been there. You make a trade, or any big decision really, and looking back, it just seems crazy.
You're left scratching your head asking, what on earth was I thinking? Well, what if the answer has less to do with your brilliant strategy and more to do with, say, how much sleep you got last night?
So here's our game plan. First, we're going to have to completely rethink how we look at risk. Then I'll introduce you to this core idea of psychological capital and a new identity you can step into, the market athlete. We'll look at how this all plays out in the real world with some stories, and then we'll wrap up with a solid plan so you can start building this edge for yourself.
All right, so first things first, we have to tear down some old ideas. For years, we've tried to cram market behavior into these tidy, predictable boxes. But here's the truth. Markets don't follow the laws of physics. They follow the messy, unpredictable, and fascinating laws of human psychology.
This just changes the whole game, doesn't it? Your job isn't just about crunching numbers. It's about predicting how other people will feel and think in the future. Those numbers on the screen, they are more like a language you have to interpret, not absolute truth. That means probabilities from the past can't possibly tell you the whole story. Real alpha comes from making those tough judgment calls. And here's the real kicker. You can't make those calls without emotion. It's always there. The trick is to stop fighting it and start treating it like valuable data.
So, if markets are all about humans, well, it stands to reason that our own human condition is a pretty massive factor. And that brings us to the absolute heart of this whole thing, psychological capital. Think of it as a real asset, just like the cash in your brokerage account, but it's one we almost always completely forget about.
So, what in the world is PsychCap? Simple. It's your personal energy tank. It's the grand total of your physical, mental, and emotional juice that you have on hand at any given moment. And, this is crucial, just like a stock price, it's not some fixed number. It's bouncing around all day, every day. Just knowing that, just recognizing that simple fact, is the first step to unlocking a whole new kind of advantage.
Your PsychCap is kind of like a three-legged stool. You've got physical energy, that's the fuel from your food, your sleep, your exercise, that's the foundation. Then there's mental energy, your ability to focus, to have real clarity. And finally, emotional energy, your grit, your resilience when things get tough. The thing is, if one of those legs gets wobbly, the whole stool is coming down. They're all connected.
And this idea leads us to a really powerful new way to see yourself. You're not just some analyst staring at a screen. You're a market athlete. And for any athlete, peak performance always starts with the body, because your brain's ability to perform is completely tied to it.
Man, this quote just hits the nail on the head. We get so caught up in thinking that trading is this purely intellectual game, right? A battle of wits. But how can you possibly optimize your intellect if the organ doing all the thinking is gassed? Your brain isn't floating in a jar. It's plugged into your body's entire system. It's what scientists call embodied cognition.
Now, let's look at a really high-stakes example of this in action. Cast your mind back to the chaos of the 2008 financial crisis. Andrew Ross Sorkin's fantastic book, Too Big to Fail, paints this incredible picture of Treasury Secretary Hank Paulson, right in the eye of the storm, lying awake at 3 a.m., night after night, totally exhausted but refusing to take anything that might help him sleep. And here's where it gets genuinely chilling. We know from tons of research that when you're sleep-deprived, your brain literally starts to see the world differently. It gets fixated on potential gains and becomes almost blind to potential losses. So you have to wonder, when Paulson and his team made that fateful decision to let Lehman Brothers go under, could it be that their bone-deep exhaustion made them overvalue the win of avoiding moral hazard, while the absolute catastrophic risk hiding in AIG's credit default swaps just didn't even register?
And if you're sitting there thinking, okay, but that's a once-in-a-generation crisis, think again. Get this. Research shows that a super simple mental task, like just thinking of words, can increase the waste byproducts from energy use in your brain by 54%. The point is, thinking is a physical activity. That feeling you get after a long day of staring at screens, where you're just completely wiped out, that's not just in your head, it's real. Your brain just ran a marathon.
Okay, so we've got the theory down. How does this actually look in the real world on a random Tuesday? Let's dive into our next section and look at two totally different stories that show how managing or mismanaging your PsychCap has a direct line to your P&L.
First, let's talk about the downward spiral. And I bet this is going to sound familiar. It starts with something small. You're feeling impatient, you jump the gun on a trade. That, of course, leads to frustration. And what do we do when we're frustrated? Something impulsive, right? We either bail too early or, worse, we double down on a loser. Then comes the guilt, because you know you just broke your rules, and now you're in this toxic soup of guilt and frustration, your psychological capital is in the red, and you're set up to make your next decision even worse.
But what's the alternative? Let's look at this story about a trader at a big bank in New York. He shows up to work one morning and he just feels off, you know? Not sharp, kind of foggy. Now, the old school mentality would be to chug some coffee and just power through. But he does something radical. He listens to that feeling. He acknowledges his energy is low and decides, I'm not trading today. I'm going to focus on other work.
So what happened? Well, the market that day turned into a total chop fest. It was volatile, unpredictable, a nightmare that just chewed up and spit out anyone who tried to force a trade. His colleagues all ended the day exhausted, angry, and down a lot of money. But him? He felt fantastic. He was clear-headed, he was energized, he was ready.
And here comes the punchline. The next day, he walks in knowing that everyone else on the floor is still hurting and probably going to be timid. But he's fresh, he's clear, he's full of energy. He saw an opportunity and had one of his absolute best trading days of the entire year. And why? It's simple. He used his psyche as leverage. He didn't just protect his cash, he protected his psychological capital and turned it into a massive tangible edge.
So when you lay it all out, you've got two completely different paths. On one side, you have the old way. Grind it out, fight for every tick, ignore what your body's telling you, and get stuck in that horrible revenge trading loop. You end every day totally drained. But on the other side, you have the psych leverage edge, taking fewer but much better trades, managing your energy first, preserving both your cash and your mental capital, and ending the day feeling clear and energized. It's a no-brainer, right?
Okay, this is all great in theory, but the big question is, how do you actually do it? How do you put this into practice? Well, let's get down to brass tacks. This final section is all about your new job description. It's about how you can start training like the professional market athlete you really are.
Here's your new playbook. Step 1, you have to reframe your job. It's not just intellectual, it's physical. That means you need a real game plan for your energy. Start mapping your most important decisions to the times of day when you're naturally at your sharpest. Get obsessed with the basics: sleep, nutrition, exercise, because that's the bedrock of good judgment. And this one is huge. When you take a loss, which is like taking a hit in a football game, you have to step away from the screen and actually give yourself time to recover.
I absolutely love this metaphor. I want you to think of yourself as a quarterback in the NFL. In the market, every single day, the other side is trying to sack you. It is a tough, competitive game. So why on earth would you willingly give away an advantage, your own physical and mental state that is 100% within your own control? It makes zero sense. You have to protect that controllable edge like your career depends on it, because it does.
Just do the mental math for a second. Think about those two paths we talked about. Now, multiply that effect over an entire year, over 100 trades. One path leads to bigger losses, feeling awful all the time, and eventual burnout. The other path leads to smaller, manageable losses, quick recovery, and a state of constant readiness for those A-plus opportunities. At the end of the year, which P&L do you think is going to look better? It's not even a question.
So I'll leave you with this one final thought, a question to really mull over. Forget your bank account, forget your brokerage statement for just a minute. Ask yourself honestly, right now, what is the balance in your psychological capital account? Are you running on a full tank, or are you sputtering on fumes? Because as we've seen today, the answer to that question might just be the single biggest predictor of your success.
Okay, so what if I told you that the secret to making better decisions under pressure isn't to think more, but to feel more? Yeah, I know. Today we're digging into this really powerful idea from an advanced trading workshop that basically flips everything we thought we knew about emotions in high-stakes situations.
All right, let's just get right into it with a question that, we've all asked ourselves at some point. Whether you're a trader, running a business, whatever. Why is it that when the pressure is on, when it really counts, we sometimes manage to make the one decision that just completely sabotages everything we're trying to do?
You know the drill. We've heard it a million times, right? Keep a cool head. Take the emotion out of it. We're basically taught from day one that our feelings are the enemy of good judgment, and that the only way to make smart decisions is from this place of pure, cold, hard logic.
But here's the thing. That conventional wisdom is exactly what we're going to challenge today. What if all of that is the absolute worst advice you could ever get? Seriously, what if trying to shut down our emotions is the very thing that causes us to self-sabotage? What if it's what's actually holding us back from making our best, sharpest decisions?
Okay, so let's get into it. We're going to start by kind of dismantling this old way of thinking. In this first part, we're going to look at why treating your emotions like the enemy isn't just a bad idea, it's actually completely counterproductive if you want to perform at your peak. So for years and years, fields like behavioral finance basically saw our minds as having only two parts, thinking and behavior. Emotions, they were just seen as this glitch, some kind of evolutionary leftover that just messes things up. But what we know now is that this picture is totally incomplete. The big takeaway here is that feelings aren't a bug, they're a feature. They're this crucial third dimension, and without them, you can't possibly understand how we actually make decisions.
We really have to stop thinking of our brains like they're just computers. I mean, think about it like this. It's like baking cookies. You can have the best flour, the best chocolate chips, all the right ingredients, but if the oven temperature is off, if the context is wrong, you just get a burnt mess. Well, in decision-making, our emotional state is that oven temperature. It's the context that can literally make or break everything. And the craziest part? It's almost always determined by whatever you were feeling just moments before. All right, so if the old model, just suppress your feelings, is totally broken, then what's the alternative? Well, this brings us to the central, game-changing idea of this whole explainer. It's this: emotions are not the enemy. They are your data. The key thing to grasp here is this idea of emotional context, or EC for short. Think of it like the psychological weather you're operating in when you have to make a choice. It's simple, right? If you're about to give a big presentation and you're feeling confident and prepared, that's one kind of weather. But if you're anxious and you feel like you haven't rehearsed enough, that's a totally different storm brewing. And here's the kicker. That context is the single most powerful predictor of how well you're going to do. So to actually use this, we need a new habit. It's kind of like checking the weather forecast before you leave the house. I mean, you wouldn't just walk out into a hurricane without an umbrella, would you? Of course not. So why do we do that with our emotions? We need to constantly check in with our internal forecast. The source material calls this marking to market your emotions, which is just a fancy way of saying you need to pay as much attention to your internal data as you do to all that external data, like stock prices or spreadsheets. And once you start doing that, it leads to this huge shift in how you think. Your emotions aren't just random noise you need to filter out. No way. They are literally the most valuable set of data you possess. The main point is this: when you learn to analyze that data correctly, it has more power to explain why you do what you do and predict what you'll do next than anything else out there.
So how do we actually start analyzing this emotional data? Well, a really great place to start is by mapping out the emotional landscape that most of us are living in, especially when things get intense and the pressure is really on.
Let's be real. For most of us, our big, high-pressure decisions, especially in areas like finance or starting a business, they're all heavily driven by different shades of the same core feelings: fear, anxiety, and doubt. And this visual just perfectly captures that fundamental tug-of-war we all feel. Every single day, you are moving back and forth along this spectrum, getting pulled between that deep, gut-level fear of being wrong and that agonizing fear of getting left behind. And what we're looking at here are the two poles of that spectrum. On one side, you've got the panic of losing. That's that sick-to-your-stomach fear that makes people sell everything at the absolute worst possible moment. And on the other end, you have the panic of missing out. You know it, FOMO. That's that crazy, manic feeling that makes people buy anything at any price right at the very peak. Now, understanding the spectrum is so important. Why? Because it's the key to spotting and stopping a really destructive pattern that pretty much everyone falls into when they ignore their emotional data. And that pattern is the emotional spiral. Come on, we've all been here, right? It starts with one small, frustrating mistake. That creates this really potent emotional context of anger, maybe some regret. Then comes that powerful urge to just get it back. So you make a second, impulsive decision trying to fix the first one. But it never works, does it? It just escalates, and before you know it, you're in what the source calls a temper tantrum of bad trades, and it ends with a massive, totally self-inflicted loss. And that feeling you have afterwards, that dazed confusion where you think, I have no idea what just came over me, that's the classic sign. See, it's not that you were out of control. It's that you were being controlled by emotions you refused to acknowledge. You ignored the data from that first bad decision, and so it infected the next one, and then the next one after that. Okay, so how do we stop this spiral? Well, the good news is the solution is actually way simpler and honestly a lot more powerful than you might think. It's not about trying to fight for more control. It's about developing more awareness.
The source material lays out this really simple 3-step practice. Okay, step 1, anticipate. Just accept that you're going to have feelings. Expect them. Don't let them surprise you. Step 2, notice. Just decide you're going to become aware of these feelings as they're happening. This is basically the data collection part. And step 3, this is the big one, name it. Put a label on what you're feeling. Actually say it. And this is where the magic happens. Just the simple act of putting a name to an emotion has this incredible effect. I mean, studies have shown that when you put feelings into words, it literally dials down their intensity. It lets the thinking part of your brain come back online, and it breaks that chain reaction, that context creep that causes those awful emotional spirals. Here is a perfect, real-world example right from the source material. There was this client who was really struggling with the feeling of ambiguity. You know, that uncertainty? And instead of fighting it, he just started to name it. He would literally write down or say out loud, "Yep, ambiguity," and kind of laugh about it. And what happened? The negative charge just disappeared. His focus came right back. It can be that simple. And you can even get ahead of the game with this. You can use it proactively. So before you make a big decision, don't just think about the logical pros and cons. Ask yourself a different question. How am I going to feel if this thing goes wrong? Or how will I feel if I miss out on this opportunity? It's like you're using your future emotions as a navigation tool, a compass, guiding your decision right now, instead of just letting them push you around later.
So look, the big takeaway here really isn't about becoming less emotional. It's not about becoming some kind of robot. It's actually about becoming more aware, more fully human. It's about having the guts to just feel what you feel, as much as you can feel it, without judging it, and then using that awareness as a massive strategic advantage. At the end of the day, this isn't some brand new system you have to build from scratch. Your brain is already doing this. It's already using your emotions as data every single second. The only real question is, are you going to start consciously tuning into that data stream, or are you just going to keep letting it run your life from the shadows? The choice really is yours. Isn't it time you started listening?
You know that old saying on Wall Street, right? Markets are driven by 2 emotions, fear and greed. It's one of those things everyone just accepts as fact. But what if I told you that simple idea isn't just wrong, but it's actually dangerously misleading? Today, we're going to dig into a much more powerful force, one that really explains the decisions we make with our money. It's called regret theory. And trust me, it might just change how you look at the markets forever.
So, here's the game plan. First, we're going to completely dismantle why that whole greed explanation just doesn't hold up. Then, we'll draw a much more accurate map of a trader's emotional world. From there, we'll pinpoint the real driver of crazy, risky behavior, and surprise, it's FOMO. After that, we'll get into the science behind it all with something called regret theory. And finally, we'll talk about a pretty surprising way you can actually use all these intense feelings to your advantage.
All right, let's jump right in. Think about any market bubble or crash you've ever heard of. The dot-com bust, the 2008 meltdown. What's the one word that always gets thrown around to explain it? Greed. It's the easy answer, right? The one that lets us all nod our heads and feel like we get it. But the truth is, greed is more of a label we slap on things out of frustration. It doesn't actually explain what's going on under the hood.
I mean, seriously, you've heard this a million times. It's the favorite line of every financial pundit on TV. It sounds so simple, so wise, like it's been passed down through the ages. It has that perfect ring of truth to it. But what we're about to see is that when you put even a little bit of pressure on this idea, the whole thing just crumbles.
And what's really wild is how long we've been using this excuse. Historians point out that we've been blaming finance and greed for society's problems since before the year 1200. That's more than 800 years of shaking our fists at the same villain. So let me ask you a simple question. In all that time, has it ever worked? Has blaming greed ever once helped us prevent the next crisis? History's answer is a pretty clear and resounding nope.
And when you zoom in on specific cases, the whole greed explanation just falls apart. Take a big-time insider trading scandal. Are we really supposed to believe that a billionaire, a guy like Raj Rajaratnam who already has everything, was so overcome with greed for an extra $70 million that he'd risk his entire fortune, his reputation, his family, and his freedom? The risk-reward calculation is insane. It makes absolutely no sense. There has to be something else going on, something much more primal.
So, if the market isn't just this simple tug-of-war between fear and greed, then what is it? Well, a much better way to think about it is as a spectrum of emotions, a landscape that every single trader has to navigate, every single day. So let's take a walk across this map together, from one side to the other.
Over on one side of the spectrum, you've got the fear of losing money. And let's be crystal clear about this. That fear is not a weakness. In fact, it's often totally rational. You'd have to be a little crazy not to be afraid of losing your hard-earned capital. The trick is to stop thinking of it as an emotion you need to suppress and start seeing it for what it is: critical data. It's your internal risk manager waving a giant red flag.
Now, right in the center of our map, you'll find the default state for pretty much every trader: a constant, low-humming anxiety of uncertainty. The markets are a non-stop fire hose of conflicting news, contradictory signals, and noise. And as human beings, our brains are wired to hate ambiguity. So living in that state of, I don't know what's going to happen next, day in and day out, well, it's just plain exhausting and incredibly nerve-wracking.
You know, this feeling was captured perfectly by a trader named Ted. He managed to sum up this whole experience in a tiny poem. He said, "Rarely a consensus, always a conversation, but with whom, I am not sure." I mean, how brilliant is that? It just perfectly nails the dilemma. You feel like you're in this important conversation, but you have no idea who you're talking to or what they're trying to tell you. You're forced to find meaning in something that's fundamentally uncertain.
And that brings us to the far end of the spectrum. And this, right here, this is the big one. This is the single most powerful and often the most destructive emotion in all of finance: the fear of missing out. FOMO. This is that gut punch feeling, that overwhelming urge that you have to be in on the action. It's the panic that the rocket ship is taking off, and if you're not on board, you're going to be left behind in the dust. This is the feeling that we constantly mistake for greed.
So let's really zoom in on this idea of FOMO, because once you learn to see it, you start seeing it everywhere. It's like the ghost in the machine behind some of the biggest financial decisions and disasters in modern history. This isn't just some abstract feeling. It has very real, very tangible, and very, very expensive consequences. Let's look at some FOMO in the wild. You see it at the very top, like when the CEO of Citigroup, Chuck Prince, said right before the 2008 crash, as long as the music was playing, we had to dance. He was terrified of missing out on the profits his competitors were raking in. You see it in your own trading, when you're up big on a trade but you just can't bring yourself to sell, paralyzed by the fear of missing out on the next leg up. You see it at the peak of every bubble, when the last retail investors finally pile in at the absolute top because they just can't stand watching their neighbors get rich anymore. And you even see it in tiny decisions, like moving your stop loss on a winning trade because the thought of it turning into a tiny loser is just unbearable, only to watch it get hit and then immediately take off without you.
In this quote right here, it gets to the absolute core of why FOMO is so powerful. It's deeply social, it's competitive, it's not just about the numbers on your screen, it's about where you stand in relation to everyone else. It's the crushing fear of being the one person who sat it out, the fear of watching someone else get rich on a trade you knew about but didn't take. That's exactly what Chuck Prince was feeling. It wasn't about the raw profit. It was about the unbearable thought of his rivals feasting while his bank sat on the sidelines. So they kept on dancing, right off the edge of a cliff.
So this isn't just some pop psychology buzzword we're throwing around. There's actually a really solid academic framework that explains the mechanics of FOMO. It's called regret theory, and it basically provides the hidden logic for why we make all these seemingly irrational choices.
So what is regret theory? Well, the core idea is actually pretty simple. When you're facing a choice with an uncertain outcome, your brain isn't just calculating the potential gains and losses. No, it's running a second, much more powerful calculation in the background: which of these choices is going to make me feel the least regret later on? We are fundamentally hardwired to minimize that awful, sinking feeling of, if only I had. That feeling is what's really pulling the levers.
And here is the cruel cosmic joke of trading. It is a game that is almost perfectly designed to make you feel regret. I mean, think about it. Unless you somehow pull off the perfect trade, buying the absolute low and selling the absolute high, pretty much every other outcome is guaranteed to make you feel bad in some way. You get in, and you're just playing wrong. That's regret. You get out too early, and you have to watch the thing rocket higher without you. That's a special kind of regret. Or you get out too late and watch all your profits evaporate. You guessed it, more regret. It's like a choose-your-own-adventure of feeling bad.
This decision tree on the slide shows you exactly what I'm talking about. So, picture this. You're in a winning trade. Path 1, you take your profits now. But then, what if it keeps running? Ugh, instant regret for leaving money on the table. Path 2, you hold on for a bigger gain. But then, what if it reverses and you give everything back? Oh, that is painful regret. Path 3, you move your stop to protect your profits. But what if one tiny meaningless dip takes you out right before the real move happens? That might be the worst regret of all. You see, it feels like almost every path leads to the same place.
And the reason we are so desperate to avoid this feeling is that regret is just uniquely terrible. It's not like being angry or sad. It's a special brand of powerlessness. It's that deep in your gut knowledge that you made a mistake, a bad one, and there's nothing, absolutely nothing, you can do to go back and fix it. You can't rewind the clock. And that little voice whispering, "if only," can haunt you. It's no wonder our brains will twist themselves into knots to avoid feeling that.
So this all paints a pretty bleak picture, doesn't it? If the market is a machine that creates uncertainty, and our brains are wired to feel regret from that uncertainty, what are we supposed to do? Are we just doomed? Well, the solution is probably the last thing you would ever expect. The answer isn't to find some perfect strategy to get rid of these feelings. The answer is to completely change your relationship with them.
So here's the new playbook. It's just 3 steps, and they're pretty radical. Step 1. Stop trying to make the market certain. It will never happen. Accept it. Step 2. Stop trying to get rid of that internal conflict and anxiety. That feeling is a normal, healthy response to the situation. And step 3, and this is the real game changer, you have to lean into it. Don't push the anxiety away. Instead, you consciously invite it in. You just feel it, without feeling the need to immediately act on it.
And here is the magic of why this works. When those feelings, the anxiety, the FOMO, the fear of regret, are operating in the background, unconsciously, they are your puppet masters. They're pulling your strings. But the moment you drag them into the light, the moment you can look at them and say, "Ah, hello, FOMO, I feel you," you cut the strings. You take your power back. You can observe the feeling. You can acknowledge the pull. And then you can choose to make a rational decision based on your plan, not on all that emotional noise.
So I'll leave you with this final thought. We spend so much time and money searching for the next great indicator, the perfect chart setup, the holy grail. But what if the most powerful edge you could ever find isn't on a screen at all? What if your greatest trading tool isn't a strategy, but your own self-awareness? The ability not to crush your feelings, but to understand them and work with them. That right there might just be the whole game. Thanks for joining this explainer.
Today, we're going to talk about something wild, a connection between the patterns you see in nature and the deepest, most hidden patterns running inside your own mind, especially when you're under pressure. All right, so take a look at this thing. It's a Romanesco cauliflower. Kind of weird looking, right? It's beautiful, for sure, really intricate. But what on earth could this vegetable possibly have to do with how your brain deals with risk, stress, and uncertainty? I mean, what if I told you the answer wasn't just something, but, well, everything? That the secret mathematical code that builds this cauliflower is the exact same one that builds the very architecture of your psyche. To really get this, we've got to start by looking at the world around us. Think of this as a little investigation. And our very first clue? It's hidden right inside this bizarre-looking vegetable. So the big secret here? It's something called fractal geometry. And it was all figured out by this brilliant French mathematician, Benoit Mandelbrot. He was the one who realized there's this hidden mathematical order to all the rough, jagged, and, well, messy-looking shapes you see everywhere in nature. You know, this is so different from the geometry we all had to learn in school, right? We learned about perfect, smooth shapes, circles, squares, triangles. But when you look outside, nature just doesn't work that way. Fractal geometry is the math for the real world, for the jagged bolt of lightning, the rugged coastline, the delicate little leaves on a fern. And this right here, this is the key to the whole thing. Mandelbrot's own words, the parts echo the whole. It's a super simple phrase, but it packs a huge punch. It's the core idea behind fractals, what's known as self-similarity. So here's how it works. You take one simple, basic pattern, and then you just repeat it over and over and over again at different sizes. Just look at a tree, right? You've got the trunk, then a big branch splits off, and smaller branches split off from that one, and even tinier twigs split off from those. But they all follow the same basic branching pattern. The same thing happens in our own lungs. It's a simple rule that, when repeated, creates these absolutely breathtakingly complex structures. Okay, so we see this organizing principle literally everywhere in the outside world. Got it. But this is where the idea takes a huge leap and becomes truly profound. What if this very same principle organizes not just nature, but our inner world, too? And that really brings us to the core question we're exploring today. I mean, if fractal geometry is the design blueprint for all of nature,
Why on earth would our own human nature, our minds, our personalities, be the one exception? Well, it turns out this idea isn't even that new. Way back when, Sigmund Freud noticed a psychological phenomenon he called transference. It's basically our unconscious habit of taking the emotional rulebook we wrote as kids and using it on totally new people and situations when we're adults. It's like a psychological fractal. Think of it like this, okay? Our first relationships, usually with our mom, they create the first foundational pattern. Then, experiences with our dad, our brothers and sisters, our first teachers, they all add new layers on top. And here's the kicker. We might think we just grow out of these early lessons, but they don't go away. Nope, they harden, and they become the unconscious lens that colors literally everything we see as adults. And, this core idea is so important that people have come up with all sorts of names for it over the years. You can call them echoes, emotional templates, or my favorite, Freud's compulsion to repeat. But no matter what you call it, it's all about these repeating, self-similar patterns that are running the show from just behind the curtain. All right, now for the really juicy part. We're going to see how these hidden fractals pop up in one of the most intense, high-pressure environments you can imagine, the financial markets. So let's meet our first case study. On the outside, this guy was a successful former banker. Looked like he had it all together. But on the inside, he was being totally haunted by this deep-seated feeling that he was just never good enough. Just listen to his own words here. The second he entered a trade, he was just flooded with doubt. He instantly felt like it was a huge mistake and had this overwhelming urge to just get out right now before the whole thing blew up. Absolutely zero trust in himself. So where did this come from? Here's the kicker. Growing up, his mother's response to pretty much anything he did was always, well, it's not quite good enough. He gets an A? It should have been an A+. He brings her flowers? She would have preferred chocolate. That critical voice, that was his hidden fractal. It became the foundational pattern, the voice in his head, that repeated itself in every single trading decision he made. Okay, now for case study number 2. We'll call him the rebel trader. And this one is fascinating because it shows how the same principle can play out in a completely different, almost opposite way. Now, this guy's situation was a total head-scratcher. He actually made money when he was just shooting from the hip, trading impulsively with no real plan. But the second he tried to get serious and follow a structured, disciplined trading plan, he started losing. How on earth does that make any sense? Well, the hidden pattern, his fractal, was all about his dad. His entire childhood was basically one long saga of defying anything and everything his father wanted him to do. So, what do you think that trading plan represented to his unconscious mind? It wasn't just a plan, it was his father. And following the plan felt like submitting to him, so he had to unconsciously rebel against it, just like he always had. Okay, so these are fascinating stories, right? But they're not just about traders. They're about all of us. Let's zoom out for a second and talk about why spotting these patterns in your own life is so important. Now, I know what some of you might be thinking. It's totally natural to be a little resistant to this idea. Of course it is. We all like to believe we're completely in the driver's seat, that we're these objective beings with total free will. The thought that some pattern that got started when you were 3 is still influencing a huge decision you're making at 35, yeah, it feels a little unsettling. So why does trading bring all this stuff to the surface? Because the market, well, it's like the ultimate impersonal authority figure. It's the ultimate truth serum. Its judgment is instant, it's final, and it's happening tick by tick. This super high-stakes, compressed environment doesn't create new problems. It just acts like a giant magnifying glass for the emotional fractals that were there all along. And I think this quote from a client just nails it perfectly. People get into trading to make money, right? Not to do a deep dive into their own psychological baggage. But for so many people, the market holds up this giant, unavoidable mirror, and they can't ignore what they see anymore. It forces them to finally confront their oldest, deepest patterns. So here we are, right back where we started. Just like that simple repeating pattern that builds a cauliflower, the oldest emotional patterns in your mind are still running, right now. They're shaping how you see the world, they're shaping your relationships, they're shaping your biggest decisions, and you might not even realize it. So the only question left is, can you see yours?
All right, today we're jumping into a story that's got a little bit of everything. High-stakes trading, some pretty intense family drama, and a really deep dive into the psychology of the market itself. This is Chapter 15, The Rise of Coup d'etat Capital.
Okay, just picture this for a second. It is the morning of your first day launching a new company. You know, the thing you've been working towards your entire life. You call your dad, and that's the very first thing he says to you. Not "good luck," not "we're so proud," but this. A question just loaded with judgment.
For the guy at the center of our story, Michael, this isn't just some random phone call. Nope. This is a head-on collision with a lifetime of criticism, and it's happening at the exact moment he's about to take the biggest professional leap of his life. I mean, talk about pressure.
So, to really get what drives Michael, we first have to understand the incredible weight he's shouldering. This whole thing, it isn't just about trading stocks and futures. It's about him trying to prove something really fundamental about who he is.
And listen to how sharp these criticisms are. His father basically writes off his entire career with one word: speculating. He says it has no value to society. He even brings up Michael's old job, saying, well, at least you were doing something useful then. It's just a brutal, calculated attack meant to shake his confidence right when he needs it most.
And here's the thing. This isn't some out-of-the-blue comment. Michael knows this is part of a much bigger, much older family pattern. It's this legacy of judgment that's been handed down from father to son, this endless cycle of criticism.
And this chart just lays it all out, doesn't it? Look at this. Michael's dad, Richard, he got grief from his own father for choosing business over a military career at West Point. And now, what is Richard doing? The exact same thing to Michael, just swapping out business for speculating. It is a seriously painful inheritance, and you can see why Michael is so desperate to break the cycle.
So, he hangs up the phone, and in that moment, he decides to leave all that baggage behind. He's in a new city, Chicago, and he's ready to build something from the ground up, completely on his own terms.
And that change of scenery, it was absolutely crucial. Getting away from all that old family drama let him finally pour all of his energy into one single thing, making his strategy work. He didn't need the chaos of New York anymore. He just needed to focus.
So, what's the game plan? Well, it's actually incredibly practical and smart. They're not trying to do everything at once. They're going to start with directional betting, and they're going to do it in the markets with the most activity. Plus, his partner, Chris, not only brings a ton of knowledge, but also a huge cost saver. They can lease his CME Group membership. It's a really lean, focused, and powerful way to get started.
Okay, now we're getting to the absolute core of Michael's big idea. For him, this is not just about crunching numbers on a spreadsheet. It's about understanding what those numbers are actually saying.
So he zeroes in on 3 specific assets to test his theories: crude oil, gold, and the 10-year Treasury note. And believe me, these were not random picks. This is the canvas where he's about to paint his masterpiece.
And that's the big question, right? Why this trio? The answer really starts to pull back the curtain on his whole unique philosophy about how the markets really truly work.
He has a name for them: social markets. And it makes so much sense when you think about it. Everybody on the planet, from Wall Street to Main Street, watches the price of oil and gold. Their prices move in a way that goes beyond borders, beyond languages. They're like a real-time report on global fear and greed. They're a universal language for human emotion.
So this is the absolute key to everything. For Michael, those squiggly lines on a price chart, that's not just data, it's a language. And he believes that if you can learn to read that language, you can start to understand the mass psychology that's really pulling all the strings.
But wait, it goes another level deeper. Because if the market is speaking a language, well, then it must have a personality, too. And just like any personality, its mood can shift in the blink of an eye.
To get a handle on these mood swings, Michael goes back and studies recent history. He looks at the insane oil boom back in '08, the explosion in gold prices that kicked off in 2010, and all the wild market swings in 2011. Each one of these events is like a case study in how a market's entire character can just change.
You know, the pros have a name for this. They call it a regime change. And it's the perfect metaphor, really. One day, a market can be quiet, predictable, just moving along. And then the next, it's like a switch gets flipped. Its whole personality changes. It gets faster, crazier, and starts playing by a completely new set of rules.
And this is the ultimate puzzle for a trader. Look, trying to perfectly nail the exact top or bottom of a trend, that's a fool's game.
The real money, the true skill, is in spotting when one of these new regimes has taken hold and riding that big, powerful move right in the middle. It's all about capturing the meat in the middle.
So, Michael's got his strategy for reading the market's language. He's got a theory for understanding its personality. But he knows there is one massive piece of the puzzle missing, the most unpredictable part of all, the human being behind the trade.
Because, let's be honest, it's one thing to have a great plan on paper. It's a whole other thing to actually execute it when your money is on the line and the pressure is on. How do you manage that gut feeling, that intuition? How do you master the sensing part of trading without letting your own emotions wreck the whole thing?
And this is his brilliant move. He goes to his partners with a proposal that sounds, well, kind of out there. He says, to manage the single biggest risk to our firm, our own minds, we should hire a full-time psychology coach to be part of the team. It's a direct admission that the biggest threat isn't the market, it's the person making the trades.
Now you might think this sounds a little strange, but he's already done the research. He points out that some of the biggest legends in the game, firms like SAC Capital and traders like Paul Tudor Jones, have been doing this for years. This isn't a sign of weakness. It's what the absolute best in the world do.
And what do his partners say? They don't even hesitate. They get it instantly. They don't see it as some kind of therapy session. They see it for exactly what it is, a smart, professional, good risk management move. They're treating their own psychology like a critical piece of infrastructure that needs to be maintained and protected.
And that just leaves us with this one final fascinating question. Michael's journey starts with a psychological battle with his father and ends with him hiring a psychologist for his firm. If the absolute best traders on the planet believe the biggest risk isn't in their computer models, but inside their own heads, well, what does that tell you about what the market really is? Maybe it was never really about the numbers at all. Maybe it's always just been about us.
So, what if the real secret to making smarter, high-stakes decisions had nothing to do with crunching more data, and everything to do with something way more primal? Today, we're diving into a pretty radical framework, one that comes straight from the world of professional trading. And it argues that your biggest asset, your ultimate edge, is actually your physical state. So forget what you think you know, it's all about how you are.
You know, we all have this picture in our heads, right? The genius analyst, eyes just glued to a wall of screens, running on nothing but coffee and a constant fire hose of data. We've been taught to believe that winning in these high-pressure games is a purely intellectual battle, a fight to see who can process the most information the fastest. But what if that whole picture is completely, dangerously wrong? The source material we're digging into today just tosses that idea right out the window. It makes the case that the real game, the one the top pros are playing, isn't just mental. No, it's profoundly physical. It's a full contact sport. And in that arena, your body isn't just some vehicle carrying your brain around. It is the single most important piece of equipment you have. Okay, so here's our game plan for this explainer. First, we are going to completely tear down that myth of the 24/7 data crunching analyst. Then, we're going to build a whole new strategy from the ground up, learning to think and act like an elite athlete. And finally, we'll lay out a concrete plan you can use to unlock your own ultimate competitive edge. All right, first up, let's really get into this myth of the trader. We all know the stereotype, right? The analyst who is perpetually wired into the market's every move, never missing a single tick. I mean, this is a life of just constant, relentless grinding. And the core belief behind it all is that more screen time, more data, somehow equals better decisions. It's a whole philosophy that treats the human mind like it's just a computer that needs a nonstop feed of information. You're waking up at 3 a.m. to check the London Open. Your phone is the first thing you grab in the morning. It's this endless, purely intellectual marathon. But you know, here's the fatal flaw in that entire approach. It completely ignores the very machine that's doing all the work, the human being behind the screen. So what if the most crucial factors, the ones that really define your performance, are the very things this old model just completely overlooks? And this right here is where we make the big pivot. It is time to stop thinking about this as some desk job and start treating it for what it really is, an athletic performance. The path to a real psychological edge doesn't begin with a spreadsheet. No, it starts by taking care of your physical self from the ground up. Just think about that for a second. A professional quarterback would never, ever dream of stepping onto the field without meticulously preparing their body first. I mean, it would be unthinkable, right?
So why should making high-stakes financial decisions be any different? Your judgment, your clarity, your ability to execute when the pressure's on, all of it flows directly from your physical state.
And the science on this is absolutely fascinating. This isn't just about feeling a little tired or groggy. When you're sleep deprived, your brain literally gets rewired to misread risk. A situation that objectively has a risk level of, say, 2.5 suddenly looks like a 2. You start to see less danger and you overestimate your chances of winning. That's not a small mistake. That is a catastrophic game-losing handicap you're giving yourself.
So these 3 things are your non-negotiables: sleep, nutrition, and exercise. Look, sleep isn't a luxury, it is a competitive weapon. And you need proper fuel because your brain, when it's really focused, burns an unbelievable amount of energy. And exercise, well, that's your reset button. It's how you build resilience. Because at the end of the day, execution is everything, and solid execution is built on this physical foundation.
Okay, so once that physical foundation is solidly in place, the entire strategic game changes. You stop being just a data analyst who's hunting for some hidden piece of info. Now you're the quarterback, ready to read the entire field. Let's be real. In a world where information is basically free and everyone is drinking from the same fire hose of data, where do you find a real edge? I mean, if the answer isn't buried in some secret report, then where is it?
And this, right here, is the strategic masterstroke. The true advantage isn't about what you know that nobody else does. It's about anticipating what everyone else is about to know. It's about being that one crucial step ahead of the crowd.
So, you're not out there searching for a needle in a haystack. You're watching the crowd itself, because the crowd's behavior is the most important data point. It's like you're playing chess while everyone else is playing checkers. You're seeing the patterns and predicting the next big move before it even happens.
But to anticipate the crowd, you need a totally different kind of data. It's one that you won't find on any chart or newsfeed. You have to learn how to read the emotional field, and the most important one to start with is your own.
You've probably heard the old saying, amateurs open the market, but pros close it. And it's so true. When some big news breaks, the amateurs just stampede in, right? They get totally caught up in the emotional frenzy. But the pro hangs back. They wait. They let that emotional storm pass. They let the chaos settle down, and then, with a clear head, they make their move.
You know that gut feeling you get sometimes, that little flicker of anxiety or uncertainty? That's not noise your brain is making. That's data. The source we're looking at calls it your emotional context, or EC. And here's the wild part. Just acknowledging it, literally just saying to yourself, okay, I feel anxious about this, can actually calm that internal alarm system down. It's like you're telling your brain, got it, message received.
A huge piece of this puzzle is knowing what's driving you. What's your dominant fear? Are you more afraid of losing the money you already have? That can lead to paralysis, right? Or are you terrified of missing out on the next big thing, that classic FOMO, which can lead you to chase every bad idea? Seriously, understanding your own fear is more valuable than any market report you'll ever read.
Okay, so we've got the theory down, but how do we actually put this into practice? Well, the final piece is the playbook, a concrete, actionable plan for building and using your psychological leverage to win.
And here it is, your 6-step plan for peak performance. See how it starts? Step 1, create physical energy. That's the foundation for everything else. Then you read other people. Then you master yourself. You use that self-knowledge to predict what the crowd will do. And that, steps 5 and 6, tells you exactly when to push your advantage and when to pull back. And once you have this framework, you can finally tear up that old, broken rulebook. And we're going to start with one of the most toxic ideas in the entire industry, the daily profit target. Trying to hit a daily target is like trying to force a river to flow uphill. It's just not how it works. It puts you completely out of sync with the market's natural rhythm and forces you to burn through your capital and your energy making bad bets. The pro strategy? It's to be patient. Conserve your capital when the market's quiet, and then, when a real opportunity appears, you go big. And really, here's the bottom line. Markets are going to shift. Technology will always change, but this internal edge, this is yours to keep, forever. When you build your performance on a solid foundation of physical energy, strategic thinking, and emotional intelligence, you unlock a kind of confidence that no market swing, no bad day can ever take away from you. This whole idea is so much bigger than just trading. This is a blueprint for how you show up to every single critical moment in your life, with clarity, with power,
and with a durable, lasting edge. You have the playbook. The only question left is, are you ready to be the quarterback? You ever have one of those moments, you make a decision, and then bam, you're hit with that question. What was I thinking? Well, today, we're going to decode that exact feeling. We're diving into this incredible framework that helps uncover the hidden, unconscious programming that drives our weirdest choices, especially when we're under the gun. Let's get into it.
Oh, you know that feeling. It's that pit in your stomach, right? You pull the trigger on a trade or a big project or even just a personal decision, and almost instantly, you're flooded with this sense of, uh-oh. You ask yourself that question, what was I thinking? But the answer feels like it's a million miles away. Well, today, we're going on a hunt for that answer. And look, these moments, they're not just random brain farts. They happen under very specific conditions, usually when the pressure is on. Imagine the market just going absolutely haywire, swinging like crazy. Or you get that frantic call about a project crisis that needs fixing right now. In those moments, when things are uncertain, a rational brain kind of takes a backseat. Something else, this deep, hidden programming, grabs the steering wheel. So, what is this hidden programming really? Well, you can think of it as your unconscious blueprint. It's like the invisible wiring diagram of your mind that dictates how you're going to react, especially when the stakes are at their highest. Now, there's a technical term for this, fractal-emotional contexts. I know, it sounds super academic, right? But the idea behind it is actually pretty straightforward. Basically, we all have these deep emotional patterns that were baked in a long, long time ago. And these patterns act like old movie projectors, taking feelings and expectations from our past and splashing them all over the decisions we're trying to make today. A really great way to think about it is like a psychological fingerprint. It is totally 100% unique to you. But here's the real kicker. This blueprint isn't just sitting there gathering dust. Oh no. It gets the most powerful, the most influential at the exact moments you need a clear head the most, when you can least afford for it to be in charge. So what does this blueprint actually sound like? Well, inside your own head, it's often a quiet little thought on repeat. You know the one, a little nagging belief like, I never can get what I want. Or maybe yours sounds more like, it's always my fault, or I just need to work harder. These aren't just random thoughts, you see. They're the soundtrack to your blueprint. And this is where the rubber meets the road. If your unconscious story is, I never get what I want, how does that actually play out? Well, maybe you sell a winning trade way too soon just to grab a tiny profit, because deep down, you just don't believe you're meant to see it all the way through. Your blueprint doesn't just stay in your head. It actively creates your reality. It's a self-fulfilling prophecy machine. So here's the big problem, right? You can't fix a problem you can't see. So how in the world do you get a look at this invisible blueprint? Well, this framework gives us a tool, a 5-step investigation. It's time to put on your detective hat and do a little sleuthing inside your own mind. Okay, here's the game plan, our roadmap. First, we're going to record our thoughts right in the middle of a decision. Then we'll do a little digging into our past memories. Third, and this one's interesting, we'll track the feelings we wake up with from our dreams. Fourth, we'll put it all together and summarize the hidden story we're telling ourselves. And then, the grand finale, step 5, we compare the present with the past and find the connection. All right, step 1, data collection. It's simple. Next time you're facing a tough call, just grab your phone and hit record on the voice memo app. The key here isn't to describe what's happening out there. You want to capture what's happening in here, your stream of consciousness, your self-talk. If you get stuck, here's a great prompt. What would your mom or your dad say about how you're handling this? Okay, for step 2, we're going to do a little time traveling. The mission is to just jot down 5 to 10 memories from before you were 18, anything that comes to mind. Then, circle the 3 that still have some kind of emotional juice to them. You know, the ones that still make you feel something. For each of those, write out the story, and this is critical. Describe how it made you feel back then and what you told yourself about it. These are the building blocks of your blueprint. Step 3 is quick, but it's really insightful. Just for a few nights, keep a notepad next to your bed. When you wake up, don't worry about the crazy story of your dream, you know, the one where you're flying on a purple unicorn. What we're looking for is the emotional hangover, the sequence of feelings the dream left you with when you opened your eyes. That's pure, unfiltered data. Now for step 4. This is where you become the analyst. You take all your notes, your memories, your dream feelings, and you start to hunt for the patterns. Ask yourself some simple questions. How do I generally expect things to go? Are there certain labels I stick on myself? What fears pop up again and again?
This is where your hidden narrative, the story you've had on repeat for years, starts to become visible. And at last, step 5, the big reveal. This is the moment it all clicks. You take the feelings from your voice recordings, from the present day, and you put them right next to the emotional story you uncovered from your past. And then you just look for the match. And trust me, it will often just leap off the page at you. The same anxiety, the same feeling of not being good enough, just echoing across the decades. That, my friends, is your fractal emotional context.
Okay, so you've done the work. You've found the pattern. You can literally see how a feeling from when you were 10 years old is messing with your decisions today. Now, what's your first instinct? To fight it, right? To argue with it, to rationalize it away. But the solution here is the exact opposite of that. It's called the ironic solution. And it's pretty wild. Let me tell you about this case study. It's about a money manager who is completely stuck, paralyzed. He hadn't been able to make a significant trade in years. And through this kind of investigation, he figured out why. He realized that for any trade, the pros and cons in his head were recreating the exact same push-pull dynamic of his parents who'd lived in the same house for years without ever speaking to each other. He was stuck in their silent war. So the normal approach would be to fight that feeling, right? To tell himself, that's ridiculous, this is about a stock, not my parents. That's what we call resistance. But the ironic solution flips that on its head. Don't fight the feeling. Join the feeling. Instead of trying to talk yourself out of the emotion, you consciously, deliberately let yourself feel it, right here and right now. You join the resistance. So that's exactly what he did. His homework was to literally sit down and imagine the argument, to hear the reasons to buy a stock in his father's voice and the reasons to sell in his mother's. And by bringing that unconscious drama into the conscious light, by actually letting himself feel that tension on purpose, something amazing happened. Its power just vanished. The hold it had on him dissolved. And for the first time in years, he made a trade. Here's one more quick one for you. A trader's boss tells him, I need you to hit it out of the park on this next one. The trader feels this crushing pressure, and his instinct is to try and talk himself down. The advice he got? Stop fighting. Go back to your desk and just fully embrace that feeling. Intentionally feel the pressure of needing to hit a home run. And his response was immediate. He just laughed and said, but if I did that, I'd probably take risk off the table. See, by allowing the feeling, he totally changed his relationship to it. Now, I get it. This whole process, this detective work, it sounds like a lot. It might even sound a little scary, which brings up a really fair question. Why even bother? Why do all this work? I mean, seriously, we buried a lot of that stuff for a reason, right? It was a way to protect ourselves when we were kids. It seems so much easier to just, let sleeping dogs lie and focus on the future. Why would you want to go digging all that up? Well, here's the absolute truth of it. The real rub. You're just tricking yourself. Those dogs are not sleeping. Those old patterns, they are running the show, whether you pay attention to them or not. They're driving your decisions from the background. And the tragic irony is that the very coping mechanism that kept you safe as a kid is now the very thing that's keeping you in a cage as an adult. And the source material we're looking at today leaves us with this beautiful, powerful metaphor. Staying wrapped up in that old programming, it can feel safe. It can feel protective, like you're in a silk cocoon. And sure, it has its advantages. But really, how does that compare to the free flight of a butterfly? So it all comes down to this. Your past is directing your present. That's not really up for debate. The only real question left is, are you going to let it keep pulling the strings from the shadows, or are you ready to step up and finally take the lead?
Okay, let's dive right in. Have you ever had a gut feeling that was so strong you just knew you had to follow it? Or maybe you followed an impulse that you really, really regretted later. We're going to get into that crucial difference, a question that really is at the heart of how we make some of our biggest decisions.
You know the feeling. We've all been there. It's that blink moment, like Malcolm Gladwell talked about, where you get a vibe about a person or a choice, and you just know. But how can you be sure it's not a trap, a feeling that's about to lead you right off a cliff? So what's the trick? How do we learn to finally tell them apart? That's exactly what we're going to unpack.
All right, here's our game plan. We're going to walk through a 6-part journey to really demystify this whole internal signal thing. We'll look at the science, pit intuition against impulse, give you some real practical tools to train yourself, and even redefine the job your intellect plays in all of this. The goal? To turn that confusing, fuzzy feeling into a sharp,
reliable tool for making much better decisions.
Okay, so let's start with the big problem, the one we all face. See, our brains are these incredible pattern-matching machines, right? But sometimes they get it wrong. They see patterns that aren't actually there. So how do we trust those other moments, the ones where we just know something is right or definitely wrong, but we have no logical reason why?
This is what this whole explainer is really about. It's about giving you the confidence to know when that powerful signal coming from deep inside you is actually speaking the truth. We want to help you move from that place of uncertainty to a place where you can confidently trust your internal compass because you'll finally understand exactly how it works.
Now, this is where it gets really, really interesting. Science is starting to show that this gut feeling is way more concrete than just, our imagination. It's not some mystical force. Think of it more like a high-speed, biological supercomputer processing data.
So let's get a new definition for intuition. Forget the magic. Let's call it what it is: experiential knowledge. Basically, it's your unconscious brain, in a split second, recognizing a pattern by sifting through this massive internal database of everything you've ever done, seen, or learned. It's the difference between reading a book about how to ride a bike and your body just knowing how to balance.
And this quote from the legendary skiing champion Ingemar Stenmark just nails it, doesn't it? My legs think faster than I do. It's like Wayne Gretzky, the hockey player who didn't skate to where the puck was, but to where it was going to be. These elite performers, they don't have time for slow, conscious thought. Their bodies and their unconscious minds have already processed all the patterns and are reacting in real time.
Now, to understand just how high the stakes can be, let's look at this really powerful true story. It comes from a 2009 New York Times article. So picture this: a 9-man patrol walking through Mosul, Iraq. It's a scorching hot morning, and they see a car up ahead with 2 young boys inside.
So one of the soldiers, acting on a very human, kind impulse, wants to walk over to the car and give the kids some water. But the sergeant in charge, he's suddenly hit with this feeling. He can't explain it. There's no logical reason, but his gut just screams, no, something isn't right here. And he later described this really specific physical sensation. His whole body suddenly felt cooler. He called it that danger feeling.
He orders his team to hold back, and just moments later, the car explodes. It was a bomb, a trap designed specifically to lure them in close. That feeling the sergeant had, it wasn't magic. It was his brain, at lightning speed, processing a million tiny subconscious cues. The odd way the car was parked, the look on the boys' faces, the quietness of the street, and it all added up to one word: danger. His experiential knowledge sent a warning that saved 9 lives.
So that story shows you just how powerful this stuff can be. But it brings up the absolute most important question. How do you tell the difference between that kind of signal and just a raw, misleading impulse? Let's break down the key differences, because this is where the theory becomes a real practical tool you can start using.
Okay, so this right here, this slide is the central idea of this entire explainer. On one side, you've got true intuition, that experiential knowledge. It usually feels calm. It kind of comes out of nowhere, like a quiet sense of recognition. On the other side, you have impulse, and you can think of this as being driven by fractal fuel. That's just a term for those old, repeating emotional patterns from your past. An impulse feels urgent, it's compelling, and it often pushes you to repeat the same old unhelpful behaviors again and again.
Now, here is the absolute best part. This is a learnable skill. This isn't some gift you're either born with or you're not. You can actually train this mind-body connection with the same kind of focus you'd bring to learning a new sport. It just takes practice and, well, a system. So here's a 4-step process you can start using like today. First, just identify the feeling. Acknowledge it. What does it feel like physically? Is it a tightness in your chest, a pit in your stomach? Second, check for that fractal fuel. Ask yourself, does this urgent feeling seem familiar, like an old unhelpful script? Third, and this one is a game changer, track the nuances. Keep a little log of these feelings and what actually happens. And finally, you've got to learn to let your unconscious do its thing. Just step away from the problem. It's called deliberation without attention, and it's actually proven to lead to better decisions. And you might be thinking, okay, but does this really work? Well, get this. One client took this idea to a whole new level. He made a spreadsheet to track every tiny little nuance of his feelings when he was making big market decisions. And after a lot of practice, he found that his experiential knowledge became over 92% accurate in predicting what was going to happen. He had literally learned to read the unique signature of his own intuition.
Okay, so what if you're trying to listen and all you hear is silence? That's a real thing. A lot of us have spent our entire lives being taught to ignore our feelings and only trust cold, hard logic. And over time, those internal wires, they can get a little disconnected.
So if you feel disconnected from these internal signals, I want you to know you are definitely not alone. The great news is you can rebuild that connection. You just have to start in a different place. Not with your thoughts, but with your body.
Reconnecting starts with your senses. Things like listening to music, gardening, making art. They might seem totally unrelated to making big life decisions, but they're not. They're foundational. They quiet down that noisy, analytical brain, and they force you to pay attention to physical feelings. Think of them like exercises that slowly start to open up those crucial lines of communication between your body and your mind.
All right, let's move to the final piece of this puzzle and see how this all comes together into a much more powerful way of thinking. This isn't about getting rid of logic, it's about giving it a major job upgrade.
Okay, so here it is. Here is the new job description for your intellect. It needs to stop being an arguer. You know that voice in your head that says, I shouldn't feel this way, or that's not logical. Instead, your intellect needs to become an analyst. The analyst gets curious. It asks questions like, okay, what is this feeling? What's it trying to tell me? Where have I felt this before? You use your incredible brain to describe and understand the data your body is giving you, not to fight with it.
Because this, right here, is the ultimate goal. As you practice being an analyst instead of an arguer, your perception just gets sharper. You'll start to recognize almost instantly the difference between that hot, anxious, fractal-fueled fear of missing out and the cool, calm, clear signal of your deep experiential knowledge. And in any part of life, that is a massive advantage.
So the key takeaway is this. Your feelings are not random noise that you should ignore. They are a high-speed data stream from the most powerful computer you will ever own, your unconscious mind. It is constantly analyzing your world and sending you reports. The only question left is, are you ready to learn how to read them?
Today, we're diving into the intense story of a trader named Michael Kelly. And this guy finds himself caught between an absolutely unthinkable family tragedy and a catastrophic market meltdown, all at the same time. It's a story about what happens under immense pressure, the psychology of risk, and that terrifying moment when a calculated bet becomes a reckless gamble. This can't be happening. You know, these are the first words that run through Michael's mind as he's jolted awake just before 1 in the morning. It's a thought that just perfectly captures that feeling of disbelief. That feeling you get when your world, both personal and professional, is about to turn completely upside down. So it all starts at 12:55 a.m. The phone rings. On the line is a Dr. Kremajek from Aspen Mountain Hospital. And the news is about his brother Tom. He was hit by a car while he was out riding his bike. The doctor's words are just chillingly precise, stable but critical. The perfect storm is brewing. And let's be clear, this is serious. We're talking a severe concussion, even though he was wearing a helmet. Both the bones in his lower leg are broken and need surgery. And he's got internal bruising so bad, they're keeping a close watch on his spleen and pancreas, worried about a slow bleed. This is a life-threatening emergency. And right away, here's the first major complication. The doctor says a family member needs to get to Aspen, like now. But the family is, well, it's fractured. Michael has to explain that his brother Tom and his father are totally estranged. They don't speak. So the responsibility, it falls squarely on Michael's shoulders. So this really sets the stage for a crisis on two fronts, where the personal and the professional are about to collide in the most devastating way you can imagine. I mean, can you imagine this? Michael's in a completely impossible position. In one ear, he's hearing the doctor say stable but critical, and at the exact same time, he arrives at his office in the middle of the night and his screens are just a sea of red. Everything, treasuries, the dollar, stocks, everything is moving against him. His professional life is in total freefall just as his personal life is exploding. And he says this to his mother on the phone, which just sums up the whole thing. He's desperate to get to his brother, but he's also managing these massive positions in a market that's going haywire. He's trapped, you know? He's trying to solve an unsolvable problem with two equally urgent demands on his attention.
So, running on pure adrenaline and zero sleep, he scrambles to put a plan together. He calls his mom. She can't go, so she tells him he has to fly out. He promises, reluctantly, to call his difficult father later. But then he makes a crucial decision. He's going to detour to the office before heading to the airport. He just has to see the London Open. And this one decision, it changes everything. So there he is, in the dead of night, staring at his screens, and everything is going against him. And right there, in this moment of extreme personal stress, his professional judgment just breaks. He starts to rationalize. The market must be wrong, he thinks. This is just a fire sale buying opportunity. So he does the one thing a trader should never, ever do. He adds to his losing positions. And this is the exact moment where emotional stress completely takes over, totally overriding professional strategy. It leads him to break the most fundamental rules of his job. So, what is a cardinal rule? Well, it's a principle so basic, so fundamental, you should never, ever break it. And in trading, one of the most sacred is right here. Never add to a losing position. Why? Because it's like you're trying to force your will on the market, betting that you, and only you, know better than everyone else combined. It's a total recipe for disaster. And yet, that is exactly what Michael does. From the airport gate, he calls his colleague Renee and says this. Think about that framing. He doesn't see a problem. He sees a once-in-a-decade opportunity. He's not just breaking the rule, he's doubling down, asking her to buy even more. Now, Renee, his colleague, she's the voice of reason here. She actually reminds him of his own rule, warning him that he's trying to force his view on the market. But Michael, he's already deep in it. He rationalizes it away, saying, no, this is different, blaming it on thin summer trading. It's this classic clash between logic and just raw, emotional conviction. And the pressure is just coming from every direction now. He gets into a tense call with his father, who's furious he wasn't called first, and then just shows up at the hospital on his own private jet. He's clashing with Renee over the trades, and then Renee says something that really hits him hard. My father would never trade that way. And Michael takes that as a deep personal attack. You can just feel him getting more and more isolated. So, feeling completely undermined and attacked, Michael makes another fateful decision. He goes around Renee. He calls his prime broker directly, the firm that actually executes his trades, and tells them to keep buying. He is now operating totally alone, completely convinced he sees an opportunity that no one else does. As if the professional pressure wasn't enough, his father delivers this crushing verdict. This is what he says when Michael explains he has to fly back to Chicago to manage the markets. It's just a brutal accusation that mixes Michael's personal guilt with his professional crisis, twisting the knife even deeper. So he flies back to Chicago on another red-eye. He's completely exhausted. He looks at his screen, and the market takes another nosedive. Now, severe sleep deprivation messes with your brain's ability to assess risk. So instead of seeing a complete disaster, his exhausted mind frames it as one final perfect buying opportunity. And he hits the buy buttons again. Renee tries one last time to get through to him. She pleads with him to get some sleep. She knows, and he knows, that you can't judge risk properly when you're exhausted. It's a rule they both live by. But he just waves her off, says he's fine. He is not fine. After a short, terrible nap, he heads back to the office. And this is where he reaches the point of no return. This is the moment he finally has to face the consequences of everything he's done. As Michael walks back into the office, he sees his boss's Mercedes parked outside. This is a very, very bad sign. Chris, the man who funds his entire operation, almost never comes into the office. But there he is, just waiting. The dread in that moment must have been unbelievable. And this is why. A single, devastating number. The fund is down over 32% from where it was just a few weeks ago. The scale of the loss is just catastrophic. All of the year's profits and a lot more completely wiped out in a matter of hours. So the situation is laid bare. Michael is still trying to justify himself, claiming the markets are way oversold. But that performance number, you can't argue with that. And his boss, Chris, just states the obvious with this chilling understatement. These positions are quite large and quite against us. Michael starts to argue, he starts to say but he gets cut off. Chris delivers the final, non-negotiable command. I'm not asking, I am telling. Get out now. It's over. The gamble has failed, and the man who put him in business is now ordering him to liquidate everything at a massive, massive loss. And this all brings us to the central question of the entire story, doesn't it? Michael was convinced he was right.
He really believed he was seeing a once-in-a-decade opportunity. But somewhere along the way, under the crushing weight of exhaustion and family trauma, that conviction morphed into something else entirely. So it leaves us with a really important question to think about. When we're under extreme pressure, how do we recognize that line where our own strongly held conviction crosses over into dangerous delusion?
Welcome to The Explainer. You know, we've all had that moment. You look back at a decision you made and just think, what on earth was I thinking? Well, today we're going to pull apart one of those moments, a truly catastrophic decision. We're not just looking at what happened, but we're going to get into the deep psychological forces that can totally hijack our rational minds when the pressure is on.
That quote is from a guy named Michael. He's a smart, successful hedge fund trader, and man, is that a chilling thing to admit. He found himself right in the middle of a financial nightmare he created himself. That quote, it just perfectly captures that terrifying feeling of losing control over your own mind. His story is an incredible look at how our past can ambush our present, and the consequences can be, well, devastating.
So, picture this. It's late at night, the office is dark and empty. Michael is sitting across from his performance coach, a woman named Denise, and he's just trying to explain how he managed to lose an absolutely massive amount of money. You can just feel the embarrassment, the confusion. He's not just explaining a bad trade, he's trying to make sense of a total breakdown of his own system.
Now, on the surface, Michael's explanation sounds perfectly reasonable, almost like something out of a textbook. He tells Denise, look, the markets were thin, it was late summer, everyone's on vacation. He was convinced the drop was just a knee-jerk reaction to some rumor that wasn't even confirmed. So he thought he was making a smart, calculated bet, a classic buy-the-dip play.
And that it is the million-dollar question, isn't it? If the analysis was so straightforward, how did it all go so spectacularly wrong? Denise, his coach, she suspects the real answer has nothing to do with market volume or any of that technical jargon. She knows the real clues aren't on a trading screen, so she starts digging into the psychological timeline of the whole meltdown.
Okay, so here's the thing you have to understand. This disaster didn't just happen out of the blue. To really get what was going on in Michael's head, we have to go back and look at the whole sequence of events, because a perfect storm of pressure was building long before he ever made that final fatal trade.
Just look at this timeline. It's a collision of two different worlds. On Friday, everything's great. His portfolio is solid. Then Sunday hits, bam. You've got market rumors out of China creating professional chaos. And at the exact same time, a personal crisis explodes. His brother's in the hospital. By Monday, racing to the airport, he makes his first big mistake. He adds to a losing position. Then, at the hospital, surrounded by family stress, he does it again. And that final catastrophic trade comes on Tuesday. The timeline shows the storm, but it's his reaction. The fact that he kept doubling down, that's the real mystery we need to solve.
And this is where the investigation takes a sharp, unexpected turn. Denise asks a really simple question. She just says, was your father there yet? And with those 5 words, a whole new character enters the story, Michael's hypercritical father, Richard. We're not talking about trading logic anymore. We're going deep into the unconscious.
So, to explain what's going on, Denise introduces this absolutely fascinating idea she calls fractal feelings. Think of it like this, like a cookie recipe. In your childhood, you've got all these ingredients, a little bit of anger, a pinch of shame, a cup of feeling powerless. They all get mixed together and baked into your psyche. Years later, a totally new stressful situation can come along, and it's like it pulls that exact same recipe off the shelf. And suddenly, you're tasting all those old emotions again, reacting to today like it's yesterday.
And here we have it. This is Michael's specific cookie recipe, courtesy of his father, Richard. We're not just talking about a difficult relationship. We're talking about a very specific cocktail of feelings. His dad always looked down on his career, made him feel incompetent, unimportant, constantly judged. Richard was a master of control and disrespect.
And this is the trigger. At the hospital, with his brother sick, his father doesn't suggest he stay, he doesn't ask, he orders him to. For Michael, that one command is like a lightning bolt. It just activates all those old, fractal feelings of being controlled, disrespected, and made powerless by the one person whose approval he could never, ever get.
And that's the turning point. In that moment, something happens deep in his subconscious. The huge emotional battle he's been losing to his father his entire life gets transferred onto a brand new opponent, the market itself. All of a sudden, this trade isn't about money anymore. It's about something way more primal.
I mean, just look at this when you put it side by side. The parallels are they're undeniable. On the one hand, you have his father, who makes him feel incompetent, judged, controlled. His father refuses to cooperate, refuses to see his point of view. Now look at the market. It's moving against him, making him feel out of control. It seems unfair, it refuses to cooperate with his analysis. The market became a perfect stand-in for his father.
And this is the big reveal. This is where Denise just connects all the dots for him. He wasn't trading against the market anymore. He was unconsciously picking a fight with his father. He was fighting for the control, the respect, the validation that his dad had denied him his whole life. In his mind, the market had to prove him right, because if it did, it would finally prove his father wrong.
And if you need any more evidence, the final piece is the most damning of all. After he placed that last disastrous, career-threatening trade, what did Michael feel? Not fear, not regret. He felt relief. He felt excitement. He told Denise he specifically remembered the feeling of not letting him control me. His emotional brain had seized complete control. The money didn't matter. In that one moment, he felt like he had finally won.
Okay, so let's put all the pieces together. Denise breaks this whole perfect storm down into 4 key psychological levers. Each one played a part, but when you combine them, they created a force that Michael's rational mind stood no chance against.
All right, first, the physical lever, sleep deprivation. He was just plain exhausted, running on empty. A terrible state to be in when you're making high-stakes decisions. Second, good old FOMO, the fear of missing out on what he thought was a huge career-making rebound. Third, there was a situational need for control. He felt totally helpless about his brother's health, right? So making a big trade gave him this false sense of power. But that fourth lever, that was the big one, the hidden one. Unconscious retaliation, that deep, primal need to finally win the fight against his father, using the market as his boxing ring.
So the mystery of what was I thinking is pretty much solved. But understanding why it happened is really just the beginning. This whole analysis opens up a completely new set of really tough questions, not just for Michael, but honestly for any of us who've ever been blindsided by our own emotions.
And this is about so much more than just money. I mean, how do you recover your trust in your own mind? If your subconscious can just grab the steering wheel and drive you straight off a cliff, how do you ever really trust your own judgment again? It forces you to face this uncomfortable idea that maybe you aren't the purely rational person you always thought you were.
And that right there brings us to our final and most crucial point. The story doesn't end with a nice, neat little solution. It ends with a challenge. The real work is learning to recognize the echoes of our own past, our own personal fractal feelings, before they start calling the shots in our present. It's about developing the self-awareness to pause in the heat of the moment and ask yourself, who am I really fighting right now? And answering that question, that might just be the most profitable trade you ever make.
All right, today we're going to talk about something kind of radical for getting back on your feet after you really, really messed up. What if the best way to recover from a huge mistake isn't to just think positive, but to do the exact opposite? Let's dive in.
We've all been there, right? That gut punch moment. A decision so wrong, it feels like you've been physically hit. In trading, in business, in life, that meltdown is a universal and just awful experience. The real question isn't if it happens, but what do you do next? You know the standard playbook. People tell you to rationalize it, to think your way out of the problem. They say, hey, stay positive, shake it off, learn from it, and move on. It's all about using your brain to override those messy feelings. But what if that is exactly the wrong thing to do? And here we go. This is the heart of the problem. As our source material points out, trying to fix a powerful emotion with your intellect is like slapping a new coat of paint on a crumbling wall. It doesn't fix the real issue underneath. In fact, it usually just makes things worse, leaving you even more frustrated that you can't just think your way back to normal. So here's our game plan. We'll start with what that meltdown really is, then get to the surprising first step to recovery. After that, we'll learn how to decode what you're actually feeling, look at a classic mistake called the no better trade, and even see how this applies to winning, before we wrap it all up with a bigger career philosophy. So this trader's meltdown, what is it? It's that moment where your judgment just completely collapses. Your intellect isn't enough to pull you out of it because your entire perception has been hijacked by some underlying emotion you might not even be aware of. You can't solve a problem when the very lens you're looking through is warped. And that brings us to the most radical and, honestly, the most powerful idea in this whole thing.
If using your intellect fails, what's the alternative? Well, the answer is definitely not what you'd expect, but trust me, it is the key to truly getting back in the game.
Yeah, you heard me right. Stop fighting it. The quickest, most effective way to start the recovery process is to actually let yourself feel how awful you feel. I mean, think about it. If you've made a spectacularly bad decision, isn't feeling like an idiot the most rational response? This step is all about getting your body, your mind, and reality all back in sync. Now, this isn't about just wallowing in misery, no. This is a structured process. It's a form of mourning. You're mourning the capital you lost, for sure, but you're also mourning your composure, your discipline, maybe even your sanity for a minute there. By giving yourself permission to feel the full weight of the mistake, you let the process begin, and more importantly, you let it end.
So this right here, this slide, this tackles the biggest fear people have with this idea. The fear is, if I open that door to feeling awful, I'm going to be consumed by it, I'll fall into a black hole. But the reality is the total opposite. When you consciously allow yourself to feel it, the feeling often just pops, like a balloon. It gets your attention, it delivers its message, and then the intensity just fades away. I love this quote. It's so simple, and it just brilliantly makes the point. As one person in the source material said, facing the feeling isn't some catastrophic event, it's just a feeling. It has information for you, and once your brain knows you've gotten the message, it can move on. It feels dangerous, but it's actually the safest path forward.
Okay, so if these feelings have information, if they're a kind of data stream, how do we read the data? This is where we need a bit of a framework for understanding what's actually going on inside our own heads.
This simple diagram is incredibly powerful. It shows that our internal state isn't just one big blob of emotion. It's made up of layers, like an onion, these concentric circles. We're moving from the most conscious, easy-to-identify feelings on the outside to the most unconscious and powerful drivers at the very core.
So that outer layer is the FC, or the feeling context. This is the simple stuff. Are you tired? Are you hungry? Are you stressed out from an argument you just had? These basic physical states create a context that colors your perception, and they're usually the easiest ones to spot.
Go one layer deeper, and you hit the EC, the emotional context. Now we're getting into the classic drivers in any high-performance field. You know, the fear of losing money, or that huge fear of missing out on a massive opportunity, what everyone calls FOMO. Where you are on this spectrum is going to dramatically change how you see risk.
And finally, at the very core, we have the FEC, the Fractal-Emotional Context. Okay, this is the deep stuff. These are reoccurring emotional patterns that were likely formed way back in your childhood. When a situation in the market today makes you feel the exact same way you did when you were a kid who got in trouble, that's the FEC at work. And it's why the reaction can feel so intense and so out of proportion. It's not just about the trade, it's about the past. So that's the theory, but how does this actually play out in the real world? Let's take this framework and apply it to a very specific and very painful type of mistake that I'm sure we've all made. It's called the BIKB trade, the but I know better trade. Oh man, does that hit home. It's the one that really stings. It's not a mistake of analysis. You didn't misread a chart. It's a mistake of discipline. You knew the right thing to do, but some invisible force, one of those emotional contexts we just talked about, pushed you to do the exact opposite. And the regret is just immense because you didn't just lose money, you betrayed yourself. And here is the absolute crucial point. The real damage from a bike trade isn't just that initial loss, it's the emotional tidal wave that follows. If you don't stop and process that feeling of disgust and frustration, you are almost guaranteed to act it out in the market, which leads to a really destructive losing streak.
There's this great old saying from the trading floors in Chicago that just perfectly captures this idea. Taking that first loss, and more importantly, processing the feeling of that loss, is the best thing you can possibly do. It cuts the destructive cycle short. It stops one bad trade from turning into a week-long disaster.
So we've pretty clearly established that not feeling your bad feelings is dangerous. But here's where it gets really fascinating. The same logic applies to success. This whole framework isn't just for when you lose, it's for when you win too. Just look at this parallel. It's a perfect mirror image. After a loss, if you don't process that anger and frustration, you end up revenge trading. But after a huge win, that unfelt euphoria and overconfidence can be just as deadly. They create a context where you feel invincible, you throw your rules out the window, and you end up giving back all your winnings and then some. The solution is the same. Consciously feel the celebration.
Enjoy it, but keep it separate from your next decision. And when you start putting all these pieces together, you realize this isn't just a tactic for recovering from a bad day. It's a fundamental shift in how you look at your entire career. And this right here is the ultimate takeaway. Success, especially in a field like trading, isn't some finish line you cross. It's a skill. It's something you practice every single day. The long run is a marathon, not a sprint. And the core skill you're developing is managing your own internal state, your psychological capital, first and foremost. So I'll leave you with this question. The market, or your job, or life, it's always going to throw waves at you. Waves of fear, waves of greed, waves of success, and waves of failure. The old approach is to just paddle like crazy and try not to drown. But with this new understanding, you have a choice. You can learn to read those waves, understand their power, and actually learn to surf your own internal state. And that changes everything.
Welcome to our Explainer. Today, we're going to tackle a huge idea about the financial markets. What if winning wasn't about having the best formulas or the fastest computers? Seriously, what if it's all just a mind game? We're about to dive into the concept that success in trading is won or lost, not on some spreadsheet, but right inside your own head.
So let's kick things off with a big question. Is the market basically just a giant math problem? You know, a puzzle that you could solve if you just had enough data and enough processing power? It's a really comforting thought, right? But the source material we're looking at today says that this whole idea isn't just wrong. It's actually pretty dangerous.
And this quote right here, it just nails the whole concept. Think about it like a high-stakes poker game. The cards you get dealt, that's the numbers, the data. Yeah, they matter, of course, but they are not what decides who wins the pot. The real game, it's all about reading your opponents, controlling your own nerves, and playing the player. That's the mind game we're talking about today.
So here's our game plan for today. First, we're going to pull back the curtain on what our source calls the market's great illusion. Then, we'll look at what happens when the numbers lie. After that, we're going to shift gears to a whole new strategy, playing the player, not cards. We'll even look at a real-world psychological coup d'etat, and we'll wrap it all up by showing you how to build your insurmountable edge.
All right, let's dive into Section 1, the market's great illusion. We're going to start by taking a sledgehammer to one of the biggest myths in finance. This idea that if you're just a little bit smarter or your model's a little bit better, you can outcalculate everybody and just guarantee a win.
Our source has a great name for this, the belief in the numerical dance. It's this idea that all you need to do is get better at analyzing the numbers. And you can see why it's so popular, can't you? It suggests that all the chaos of the market can be tamed, that there's some kind of predictable rhythm we can learn. If we just master the steps, we'll never miss a beat.
This slide really lays it all out, side by side. On the left, you've got the common view, the market as this math puzzle, where numbers are the absolute truth. But on the right, that's the reality our source is pushing for. It's a human game. And suddenly, the goal isn't to solve the market anymore. The goal is to understand the people, the players, and all their fears and biases. And that one little shift, well, it changes absolutely everything.
Okay, so if the numbers are everything approach is a myth, where's the proof? That brings us to Section 2, where we look at those moments in history when the numbers didn't just mislead us, they flat out lied.
And believe me, history is absolutely littered with examples. You've got black swans, those completely out-of-the-blue events that no financial model could ever predict. You've got the famous story of the quants, the geniuses whose super complex math models just spectacularly blew up. And then there are flash crashes, where markets just nosedive in minutes, driven by algorithms and pure human panic. And what's the one thing they all have in common? They are all moments where raw human psychology completely overwhelmed any kind of numerical logic.
This quote really drives the point home, and it's kind of chilling. Ignoring the unconscious, all those hidden drivers of fear and greed in yourself and in other people, that isn't just a simple mistake. It is your single biggest risk factor. And the source is blunt about it. It's not a question of if these hidden forces will burn you, it's a question of when.
Okay, so we've laid out the problem with the numbers-only approach. So, now what? What's the solution? Well, that brings us to our third section, a whole new framework that's all about playing the player, not just the cards you've been dealt.
So the very first piece of this new framework is what the source calls mental capital. And this is a huge identity shift. You have to stop thinking of yourself as an analyst sitting behind a desk.
and start thinking of yourself as an elite athlete or a performer. Your mind, your emotional control, your focus, that becomes your most valuable asset. That's the real capital you have to protect above all else.
The second piece of the puzzle is psychological leverage. And no, this has nothing to do with borrowing money. This is all about using your understanding of human behavior to get an edge. It's about reading the room, not just the balance sheet. You start looking for the story, the emotion, the narrative that's driving the numbers, not just the numbers themselves.
So what does this actually look like in practice? Well, this slide shows you the before and after. The old way, which the source calls CYE for control your emotions, was all about trying to become a robot, suppress your feelings, be a machine. The new way? It's the exact opposite. Your emotions, your fear, your greed, your excitement, they aren't liabilities anymore. They are critical pieces of data. The goal isn't to be emotionless, it's to be a self-aware athlete who knows how to listen to and interpret every single signal their body is sending them.
Now, this all sounds pretty fascinating in theory, but the big question is, does it actually work in the real world? Let's move on to our fourth section and look at a case study from the source that shows these ideas in action, a story of a very successful psychological coup.
So let me introduce you to a firm called Coup de Capital. And get this, their name was basically a declaration of war. Not a political war, but a philosophical one. It was a coup against the tyranny of a numbers-only approach to finance. Their entire strategy was built on these ideas of mental capital and psychological leverage. And you won't believe their path to success. It's like something out of a movie. It starts with a random meeting in a Chicago taxi line. That leads to a conversation at a conference where they pitch their radical new philosophy. This gets them this once-in-a-lifetime invitation to pitch a major investor in Monaco. And when they get there, they don't talk about algorithms or spreadsheets. They talk about the human brain. And it works. They land the investment and prove that their psychological approach isn't just theory, it's incredibly profitable.
And this is the real key to their story. That first huge win wasn't just about the money. It completely cemented their entire culture. As the source says, from that day on, no one in the firm forgot to anchor everything in this new psychological framework. It became who they were. It became their identity.
All right, this brings us to our final, and honestly, our most important section. How do we take all of this and make it work for you? How do you actually apply this framework to build your own personal, insurmountable edge? If you only remember one thing from this whole explainer, please make it this. The mind game of the markets is not happening out there somewhere. It's happening inside your own head. It's all about your perceptions, your interpretations. And that should be incredibly empowering, because your own mind is the one and only battlefield where you can have total control.
So how do you actually build this edge? Well, it starts with these principles right here. You have to really internalize that your perception of reality is your reality in the market. You have to learn to separate what happens from your interpretation of what happens. And most importantly, you have to become aware of your unconscious drivers, the ego, the fear, the greed, and drag them out into the light. In this game, self-knowledge isn't some soft skill. It is your sharpest and most effective weapon.
And the payoff for all this internal work? It's just profound. As our source puts it, you create an edge that is truly insurmountable. You know, strategies will come and go, markets will boom, they'll bust, but a deep understanding of your own mind, that is the one asset that no one and no market condition can ever take away from you.
And look, this isn't just some feel-good philosophy. There's a real, tangible outcome here. The source makes a pretty bold claim. If you can learn to put your mental state first in just half of your decisions, you can dramatically improve your results. Think about that for a second. A 50% shift in your focus could lead to a monumental shift in your performance. That is a powerful, powerful incentive. So we'll leave you with this final and maybe the most important question from the source. We've established that your unconscious is your biggest risk factor. So take a quiet moment and ask yourself, what is it trying to tell you right now? Answering that one question might be the most profitable trade you make all year.